Tokenmetrics is a cryptocurrency investment platform that helps users leverage machine learning to become better crypto investors. Our in-depth analysis helps eliminate the emotions of investing, find profitable investment opportunities, and filters out scams. Learn more at tokenmetrics.com.
Hello, hello. Happy holidays. Happy New Year. Hope you had a wonderful Christmas. It is time for a very, very special holiday live stream with yours truly, Ian Bellina. Technically, I'm on vacation, but I love you all so much. I wanted to really do a deep dive live stream. What's up, everybody? So first person on the live stream was Warren. What's up, Warren? How are you? Then we got John. We got Eric. Farmer, what's up? Rhoda, what's up? What's up? Yes, yeah, we are back. Just like the good old days. All right. So it's going to be a heavy duty live stream. So sit back, relax. It's going to be fast paced, a deep dive. So to kind of set the frame, let me hide this. So first of all, if you're brand new to Tokenmetrics, to our YouTube channel or to our platform, welcome. Welcome to the crypto family. Welcome to the Tokenmetrics family. My name is Ian Bellina, founder and CEO of Tokenmetrics. And this is going to be a jam-packed masterclass on how to invest in crypto. Right? So for those who know, my book has been out, right? Crypto Investing Guide on Amazon, how to invest in Bitcoin, DeFi, NFTs, and more. And this holiday season, on Christmas Eve, the audiobook finally came out. Right, so if you go to Amazon, let me pull this up over here. If you go to Amazon, the audiobook is now available, right? So you can buy the audiobook on Amazon. You can buy it on Audible as well. Just go search for Crypto Investing Guide, and also iTunes as well. So pretty much anywhere where audiobooks can be bought, the book is now available on audio. So you have no reason not to become a crypto expert. No reason not to be a crypto investing wizard, right? Because this is about making money, right? You have to take advantage of the opportunity during the lifetime of the opportunity. And right now, we're going through a parabolic bull market, right? We've had great investments like Helium Network, Polygon, which is now pushing almost $3. And now you have Uniswap getting added onto Polygon. And these are giving life-changing returns. Life-changing. Not only to our customers, even to our community on YouTube who aren't customers, right? Because it's about really pushing our mission forward of bringing economic empowerment to all of humanity globally, right? So definitely, I recommend, if you haven't, go get the book, right? And to us, it's not really about making money, right? Because you can get this book for free as an ebook on our site. If you go to tokenmetrics.com, and so if you go to our website here, first of all, I definitely recommend you subscribe and try out Tokenmetrics. We do have a holiday coupon code still going on. If you use the coupon code TM Holidays, one word, all caps, TM Holidays, that gets you, I believe, 25% off. So 25% off if you buy the annual plan. So definitely go out there, leverage data and AI to become a smarter crypto investor. And if you go all the way down here to the book here, this lets you, this is the link to buy the book, right? But if you just, let me refresh it real quick. There's an exit pop-up technically. So tokenmetrics.com/crypto-investing-guide. Then you go all the way down here, free download, right? So free download, just put in your email. This gets you added to our crypto investor newsletter. We have over 100,000 crypto investors globally subscribe to our newsletter. We have a weekly newsletter, so definitely make sure you join that. And that's all you have to do to get this book, the ebook version, for free, right? Now, if you want the audiobook, then I highly recommend you get it on Audible. Audible is my preferred platform, but you can also buy it on Audible through Amazon. And look at this, 4.7 stars. So definitely thank you for all the support, all the love, crypto family, as we like to say.
We just landed on the moon in the Lambo.
Yeah, definitely appreciate you. If you've read the book, definitely go and leave us a review. It helps with getting the word out there, spreading the mission of crypto and evangelizing crypto. And same thing, if you just got the audiobook, same thing, go out there and leave a review. Let us know what you think. All right. So where do we start with crypto investing, guy? All right, so this is going to be a masterclass. What does that mean? That means I don't know how long this live stream is going to be. This could be an hour-long live stream, probably not. This could be a 3-hour-long live stream, just like in the good old days. But I want this video, this live stream, to be a jam-packed video that you can send to any of your friends who are curious about crypto, and it gives them the blueprint on how to invest in crypto, right? So basically, I'm going to go through every single chapter in the book. There are about 14 chapters, I believe, and we're going to go through every chapter at a high level and giving you basically the Cliff Notes version of why that chapter is important and how to apply it in the real world, right? Because it's one thing to read, but just have to apply, right? Reading without applying is not really knowledge. All right, so now, because this is going to be a live masterclass, I won't really be checking too much the comments. I will check in to see if there are any errors or any issues, but basically save this, bookmark this, share this video, tell a friend to tell a friend. Not being in crypto is a financial crime, but this is going to be something you can bookmark and save for the record books. All right. So let's begin first up with intro to blockchain and crypto. Yes, we're beginning from the basics. Intro to blockchain and crypto. Why is crypto important? Why is crypto valuable? Right. So you've probably seen lots of videos talking about what blockchain and crypto are, right? But I haven't really covered this since like 2017. And we have so many new people coming to our platform and our channel, but where do you start? How do you explain blockchain and crypto to somebody who's new, to a newbie? Right? So beginning at a high level, I think of people have been explaining blockchain and crypto as this new form of money. Yes, that is true. Right? For me, a better way to view this, which is now becoming true, is blockchain and crypto assets, or cryptocurrencies in general, are the evolution of the next internet. So yes, it's disrupting money, but it's much bigger than that. We're disrupting the whole internet. Right? So if we take a step back and we go with Web 1, Web 1 was essentially the first evolution of the internet. It was the first internet. It's a dot-com era. It's basically Google, Yahoo, all the search engines, eBay, Craigslist. It was the dot-com era. It was for the first time you could consume information globally through a network called the internet. Right? And I think if you're watching this on the internet, you already know what the internet is, right? So it's an easier place to begin. Then you had Web 2. Web 2 is essentially social media. Why was Web 2 so disruptive? Web 2 essentially allowed the user to create the information, and it allowed the users to connect with each other. You basically had social networking. That's basically Web 2. You had Facebook, you had YouTube, you had Twitter, you had Instagram, you had WhatsApp. Basically, users could talk to other users and really start to build online communities and online forms of engagement. That's all it was. That's Web 2. Okay, so I think that part is easier to get. Okay, next part, Web 3. This has become a buzzword. But before this was even a buzzword, this was really what blockchain was all about. Web 3 is building upon Web 2. It's taking those same concepts of the internet, of Web 2.0, but now it's removing central authority. It's removing any intermediary, from central banks to governments to middlemen to rent seekers, essentially, and it's creating everything peer-to-peer, but it still maintains trust. So two strangers on the internet can still participate and engage and transact and still have trust. And that's all being done via the blockchain. What does that mean? Right? We've seen the errors of Facebook. Facebook's data mining and stealing people's data on the internet. How do you solve that? What if you could build a Facebook with no Facebook? That's powerful. What if you could build a Twitter with no Twitter? What if you could build a YouTube with no YouTube? Where all the information was held by the entire network and nobody actually owned it. And if anything, you owned your own data. You owned your own information. So Facebook cannot data mine unless you gave them the permission to. Where basically ownership is not owned by a central company like Facebook or YouTube or Google. Ownership is owned by you, the individual, the user. That's powerful. That's Web 3. And that's being powered by blockchain. What is blockchain? At a high level, blockchain essentially is a database. I know it sounds very simple, but it's basically a database, except the ledger is being shared by every user. Well, not really in reality, but hypothetically, every user confirms that ledger via basically miners or nodes, and everybody has a single version of the truth. What does that mean? that means my blockchain, my database, and your database is exactly the same. If there's an issue, if there's a discrepancy, then there's an issue, right? So blockchain at a high level is really just a decentralized database. So if you're a newbie, just think of blockchain as a decentralized database. And the whole network, everybody on the network has the single version of the truth, has the same version. That's how you're able to have no central authority at a high level, right? Now, what's a crypto asset? What's a cryptocurrency? A cryptocurrency is a medium of exchange, but I like to view it more as take money in the real world, cash, fiat, mullah, dineros, whatever term you have for it, shillings, right? Take real analog cash in the real world, and make it digital. That's not that huge of a leap. So for instance, because nowadays we have PayPal, we have Venmo, we have Cash App. That's all cryptocurrencies are, except as opposed to me sending you via PayPal dollars or euros or yen or whatever, right? I am sending you a cryptocurrency that is owned by the whole world. For example, Bitcoin or stablecoin, right? So in this new internet, in this world of Web 3.0, there are no central authorities that own the data. Everything is owned by the community. Think of it as almost like open source, right? So in this new world, how do you disrupt money? Right? Because it's not that big of a leap to imagine that you'll have digital money in this new world. Or this digital money is not owned by the US dollar, the US Federal Reserve or other central banks. You, the user, and the community come together and you decide what asset holds value. So that's all crypto assets are. It's digital money with no central point of contact. Like Bitcoin has no CEO, is a joke, right? But that's why it's powerful, because it's immutable. You can't really shut down Bitcoin because there's no CEO to call for Bitcoin. On the downside, there's no customer support line for Bitcoin as well, right? But that's the power of Bitcoin. Why is that powerful? Because if you go into other parts of the world, right, in developed countries where people don't trust governments, how do people maintain or store their wealth if they don't trust the government, right? For example, in Turkey and Lebanon, where the inflation in Lebanon is ridiculous. I think, let me see if I can get the exact inflation for Lebanon, because it was published recently. Just give me 1 second here. Okay, so okay, all right, so I have pulled this up here. Okay, so the average inflation rate by September 2021 reached 132%, basically 133% almost, higher than the average inflation rate of 66%. So think about this. Your money, your wealth, your family's wealth, the generational wealth you're trying to build for your future generations is basically going to zero. Not because of your wrongdoings, but because of your government's wrongdoings, because of the place you were born. And this is what crypto is trying to disrupt, right? At a high level, I keep on joking that not being in crypto is a financial crime, but that is the truth, because you're losing purchasing power. What does that mean? That means, take for example your rent, right? If your rent is what, $2,000 a month, and you have $2,000 in the bank account, the price for your rent, the price for essentials, right? Household stuff, household items, and bills is going up, while the purchasing power, the amount of stuff you can buy with your dollars, is declining, right? Ever since the US got off the gold standard, everything has basically been declining, right? So at a high level, let me see here, US purchasing power. Right, so the same assets that you would buy, so here's a picture, right? So this is the purchasing power for the US dollar over time, right? So value of $1 was basically $26. But now, the value has been debased to a point where it's basically becoming worthless, right? So imagine if the money you have in your bank account in 5 years, by doing nothing, you wake up and you can buy a lot less things than you could buy 5 years in the past. That's what it means by you're losing purchasing power. In essence, you're losing wealth. You're being robbed, right? So how do you prevent that in this new world? You have to find other ways to store your value. And crypto assets like Bitcoin, Ethereum, or even these centralized stablecoins, they help with that. That's what they do, right? So that's that at a high level. Let me just check in here. Hey, what's up, Mark? How you doing? Mark says the dollar is still king of fiat. Yes, it is. So actually, one of the books on my to-read list is Ray Dalio. His book that just came out. Ray Dalio. Yeah, Principles for Dealing with the New World, with a Changing World Order. Right? This is on my to-read list. But basically, Ray Dalio is, I think from what I've heard, he's predicting the collapse of the US dollar. Right? Basically, the changing world order, why nations succeed and fail. And I think from a friend told me to read this book. He basically goes through and studies big civilizations and what made them decline. And I think, don't quote me on this, I think he's basically predicting the US is on the decline and the Chinese empire is on the up and up, right? But anyway, that's for a different controversial video. But definitely worth looking into. But anyway, that's basically intro to blockchain and crypto assets, right? Next up, chapter 2, how to use and store cryptocurrencies, right? So basically, to use cryptocurrencies, you have to have a wallet. So the wallets I recommend, one is a Ledger wallet, right? For those who don't know, back in 2018, I was hacked for 2.4 million to 2.5-ish, basically $2.5 million, right? Because I stored my private keys on a web service, whatever, right? Evernote. I thought I was being private or whatever, but hackers, they will find you, especially if you're a public figure like me. The good thing is, thanks to help of the FBI, they're able to find the money and get it back. So, as we like to say,
We just landed on the moon.
Thank you, FBI. But basically, after that, I learned my lesson, right? Store everything on a ledger, if you can, right? It's basically, looks like this. It's basically a USB device, and store it there. That's how you should store your cryptocurrencies. Now, it is somewhat technical, but just go to ledger.com and buy a ledger, right? Basically, there are two ways to store crypto that I recommend, right? So the first one, Ledger Wallet. So let me pull this up here for those who want to purchase this. Right, so they have different versions that come out all the time. I have Ledger Nano, I believe. Okay, yeah, so this is basically the device, right? So this stores Bitcoin, Ethereum, and other crypto assets. Now the downside of a ledger is, as I switch over here, actually I'll stay here, right? The downside of a ledger is you can't store too many different crypto assets, right? Because if they're different blockchains, it has a limitation on memory, right? At least the ledger I have. I believe the new ledger, so I have the Nano S. Nano X doesn't have as many good reviews for some reason. But I highly recommend getting that. And I highly recommend getting a bunch of them, right? Why do that, right? So, basically after I got hacked, I went out there and I bought a bunch of ledgers. I have like 10 ledgers. And then you can clone a ledger and basically have different backups in different parts of the world, right? So that's what I actually have, right? So that way, if your ledger gets lost, you have a ledger that has the same exact private key that helps you recover your wallet with you, right? Why do that, right? You want to de-risk and decentralize all avenues for getting hacked, right? There's a chapter on basically hacking and security. But for now, in terms of storing your ledger, make clones of your ledger and keep them in different places, right? I know some people who keep them in safety deposit boxes at bank accounts, at banks. That I don't trust so much. There have been stories of bank employees going through and stealing people's crypto, right? So that makes me not want to do that. You can store it at different places, maybe your office and home, or maybe at a friend's house or parent's house or whatever. But basically, find out what works for you, or maybe even a different continent, right? But basically, find out what works for you, and make sure you have different places, right? For example, I think the Winklevoss twins have theirs spread out throughout different places in the U.S., right? Whether banks or whether lawyers or whatever, right? Because they have over $1 billion in Bitcoin, right? So they want to make sure nothing gets hacked, right? And what they do is they take like half the private key, and theirs is done via paper, not a ledger, right? You can use a paper wallet, but I don't really recommend that. I mean, you could unless you have lots of money, right? But anyway, that's one wallet to use. The other wallet you can use, if you're on phone or the mobile, I've heard of Rainbow Wallet. Now, I've not used this myself, but this has been pretty popular amongst DeFi users. All right, so let me switch over here. So this one is pretty popular for DeFi amongst the Ethereum community, right? Rainbow Wallet, so definitely check this out. Then Coinbase Wallet as well is also very popular. All right, so you got Coinbase Wallet. And then you also have MetaMask. MetaMask is needed for, it's basically a browser wallet, wallet inside your browser that you use to interact with DeFi. We'll get into DeFi later, but basically if you want to have a wallet on your browser, use this, right? Now what I do is, for DeFi, I use MetaMask, and you can integrate this with Ledger, right? Because when you use Ledger, you physically have to confirm a transaction by pushing down this button here, right? So this means that nobody's gonna hack you unless they physically have a ledger. That's the upside of a ledger or hardware wallet, right? Cold storage, right? Because unless somebody physically has this, they ain't getting nothing, right? So if you integrate this with MetaMask, every transaction on MetaMask and DeFi, you have to confirm physically by pushing down this button to accept the transaction. So less likely to get hacked, right? Now, when it comes to security, nothing is bulletproof. Hackers have been known to even hack hardware wallets, right? But they're still a lot safer than just regular wallets, right? Then one other app I like for tracking all this is Zapper.fi. If you go to Zapper.fi, this works with most blockchains. So this is pulling up my Ethereum wallets and Avalanche and Polygon, right? But basically, this is pretty cool. Think of this as your banking center for crypto and DeFi for your portfolio, right? I like to use this to track my portfolio. These are not all my crypto assets, but this tracks most of them, right? So in this wallet is pulling in my Ethereum, Polygon, Avalanche. Why is it not showing this? Give me 1 second. Typically, it would also show me my loans. But anyway, so this also pulls in my NFTs. So in this instance, this is my NFT collection. NFTs is one of the last chapters in the book. We'll get into that. But this is basically what I would be using if you're brand new to crypto, right? And then last but not least, crypto exchanges, right? So if you're brand new to crypto and you're not tech savvy, sometimes trying to self-custody your own crypto is dangerous, right? Because I know people, this is almost a rite of passage in crypto, losing your private key or losing access to your crypto. I mean, anybody who's been in crypto for a while, they have lost money by not storing their private key properly, myself included, right? I lost over 6 figures in one chain back in like 2018 because their crappy desktop wallet just didn't work properly, basically. And it crashed as I was storing my password and my private key, and I cannot recover that. A good thing was I did sell some on chain, so I didn't take any L. But I mean, losing out on 6 figures is not ideal, right? So what do you do in that instance if you have a crypto asset or blockchain that is not supported with Ledger, right? Like this, what do you do, right? So in the book, definitely buy the book if you haven't already, right? Because this whole masterclass is about the book. This is a high level. The book goes into everything at a deep level, right? But basically, you can buy what I call password protected USB drives. Not sure if you guys can see that. Right, basically, it can be a USB drive, it can be a portable hard drive, but basically make sure you get something that you can encrypt and store your private key there, right? Because sometimes either that or a paper wallet, right? So either that or just print out a paper wallet and store it somewhere, have a backup, maybe at home or somewhere else, but basically find ways to store that crypto and encrypt it, right? So with this is similar to a ledger. You have to physically put in a password to even access this, right? And then once I access that, I then also encrypt that as well with software, right? So it's basically double encrypted. Now, I'm no IT security expert per se, but I have been looking into this deeply after getting hacked, right? Now, I think that is a good place to start, whether that or a portable hard drive. So for instance, let me open up this other hard drive. So one I recommend is the Samsung SSD drive. This is like 1 or 2 terabytes. You can buy this on Amazon or online. You can just buy this and encrypt this with software. Now, one thing to note, all the stuff we're doing is not bulletproof. If a hackers really want to get through it and they're smart and they have the time, they can get it, right? So basically, I mean, the CIA can hack this, right? The CIA can probably hack a ledger too, right? But unless, if you don't have the CIA coming after you, then you're good, right? You want to create as many obstacles for hackers as possible, right? So you can encrypt this with a Mac. You can do it through File Vault. With Windows, there's different. I think with Windows there's bit something that comes with Windows that helps you encrypt hard drives. But basically, software encryption can be hacked. Same thing with hardware encryption. But somebody has to really be good at it, and they have to really want to come after you to hack it, right? So it's not bulletproof, but it's better than nothing, right? All these are just barriers we create. And that's how I would store crypto. All right, let's check in the comments here. Yes, I mean, Trezor is pretty popular as well, but I prefer Ledger over Trezor. I've never used a Trezor before. Yeah, BitLocker for Windows. Thank you, AD. I appreciate that. Okay, let's, I mean, so this is not a news, this is a masterclass. This is not, so if you want the market update, I think Bill's on vacation. I'm not sure. I have to double check, but that's a different video. But we're basically doing a deep dive on the book, right? So back to the chapters here. Okay, so now chapter 3, we'll do a real deep dive on securing your crypto from hackers, right? So if you're brand new to crypto, these are the most common ways to get hacked, right? 1, exchange hacks. What does that mean? Basically, how hackers will hack you is they will go through your exchange. So Coinbase, Binance, whatever, right? And they'll hack your account. And ways to prevent getting your account hacked is making sure you always generate random passwords that are long that you have never used anywhere else, right? So you want to use a password generator. Trust me on this. If you don't use this, you will get hacked, 1,000%, right? If you're using the same password, that's how you get hacked, right? Because to go deeper into how I got hacked, right? That's what they did. I mean, I thought I was being cool, being secure and everything, but basically, I had my Gmail account, which had 2FA, two-factor authentication, and I still got hacked. Yes, with 2FA, right? So what I believe happened is this. Even though my Gmail had 2FA on it, the password recovery functionality on Gmail does not require 2FA. And basically, the one that went to Gmail said, forgot password, and Gmail sent a password reset notification to my college email. And I didn't use my college email in like almost 10 years. And guess what? My college email didn't have 2FA at all. And the password for my college email was part of this data breach online right? So you can check if your email has been hacked by going to sites like, I think I've been pwned. Right, so basically you can come here and go to ihavebeenpwned.com. This is the site. And basically all these different data breaches that are not your wrongdoing, the company goes through and basically gets hacked, right? So if you pick any random email, let me just take a look. Which one should I pick? Let's just pick, this is not my email, but maybe somebody else's email, right? So this one, ian@gmail.com, right? They've been pwned, right, through data breaches, right? So this person had their account information at 8fit, which is a health and fitness application, get hacked. 8tracks, Adobe, Animoto, and basically, lots of different companies, right? So with me, mine was part of a Dropbox and Adobe data breach, right? So basically, all the account information and passwords, they get stolen. Basically, those companies are hacked, and that data is resold on the black web. Sometimes it's even free. Sometimes it's a data dump, right? So basically, once those hackers have those data, once they know your account has been pwned, they can go on the black web and look for 8fit data dump, find your email there, your password, and log in, right? And with me, right, the issue I mentioned is my college email had no 2FA. And because back then, I finished undergrad in 2010, grad school in 2012, and I was not thinking about getting hacked for crypto back then, right? So, if you're a target, they'll come after you, right? So, the way past that is to use password generators, right? So, ones I recommend in the book, LastPass is one. There's so many. There's Dashlane. I use all of them for different things, right? But basically, you come here and it generates a password for you, right? Now, let me just check something. Give me 1 second. I want to just see if I can showcase this. Right, so basically, not sure, okay, it's not showing my extension pop-ups. Okay, so I can't showcase that. But basically, this lets you create random passwords, right? And I recommend any password for anything you ever create. If once you enter crypto, no looking back. Every password should be long as you can make it, right? Basically 15 characters or more, ideally, right? And everything, everything should be password protected with a long password, right? So basically, no password gets reused anywhere. Every site is a new password. The great thing about it is this stores everything in your computer or browser. So there's LastPass, there's Dashlane, there's even an open source version, right, which I use, Bitwarden, right? Bitwarden is pretty cool. If you really want to go off the grid, you gotta, where's Bitwarden? So Bitwarden, you can actually run your own server, right? Because it's fully open source. So if you want to go the open source route, I have used this as well. It's pretty good, not as user friendly, but if you want to go completely off the grid, if you're worried about, for example, LastPass, Dashlane getting hacked, you can run your own node, your own server for Bitwarden that nobody has access to except you, right? So this is pretty powerful for that, right? But essentially, all these different password managers, you also want to have two-FA on them, two-factor authentication, right? So there are lots of different apps you can use. But basically, two-factor authentication is a mobile code you get on your phone via an app that you have to punch in to log in, right? Have you ever logged into a site? Never use your phone or SMS for logging in for 2FA. Because if you use your phone, you'll get hacked. I'm sorry. In crypto, they'll SIM swap you and it's a wrap, game over, right? So what do you do then? If you're in crypto, always avoid SMS, right? Because let's say you have your account on Coinbase or Binance, and they sent you an SMS code to log in. The way they hack you is they call. Oh, I'm sorry. The basically two main ways you get hacked via SMS or SIM swaps, right? One, the dark web, right? This has been known. The stories on this, basically rogue employees, right? Basically employees for phone companies going and selling like admin login information on the dark web. Right? Imagine an employee at AT&T, whatever, Verizon, right? Who hates their job and wants to make some money, right? Whether a few $100 to several grand or more, they go on the dark web and say, hey, I'll give you access to these phone numbers, whatever, right? Well, stuff like this does happen on the dark web. And basically, they will port your phone number to somebody else. And once that hacker ports that phone number to their phone, they can intercept those SMSs, right? Basically, their phone becomes your phone. I mean, your phone becomes their phone, right? So they can go to Coinbase once they have your login from being hacked, and then put in that SMS verification pretending to be you, and they're into your account. This happens all the time, right? Guess what? There's a solution to protect against that. This is what I use. It's called Ifani. I had an interview with the founder. Basically, it's designed for people in crypto and people who are targets, right? They protect against SIM swaps because they have what they call 11 layers of security. So basically, nobody's going to finesse them into, obviously nothing is bulletproof, but nobody's going to finesse them into getting hacked, right? Or giving out your SIM swap, right? Because they verify everything. They'll hop on a call with you, video call to make sure it's you. They'll freeze the account. Like, they're very popular amongst people in crypto, amongst athletes, celebrities, anybody who's a target. If you have a large amount of money, I would just have a second phone and use Ifani with it. I'm not even going to use our affiliate link. Just go up there, join them, thank me later, tell Hasib I sent you. But I mean, this is basically if you have more than 6 figures in crypto, you gotta have Ifani. I mean, they cost $100 a month, but I mean, that's better than getting hacked for 6 figures or more in crypto. All right, so basically no SMS, use 2FA, and protect your phone from SIM swaps with Ifani. And then back to exchanges, right? Apologies, I'm kind of jumping all over the place here. So we talked about phone hacks, SIM swaps. We talked about exchange hacks. Then phishing attacks, right? So it's very common for hackers to play the numbers game by having fake emails, because hackers, they can copy and paste the website. They can copy and paste Coinbase, Binance, Facebook, and have the site look exactly the same, exact login information with a different domain name, and basically trick you to submit information. I've had lots of people in crypto tell me that they've gotten hacked from phishing attacks. And the way it works is they send out an email looks legit, you click that link, you put in your information, and turns out they steal your information, your password, your login. How do they do that? They can be very deceptive with URLs, right? Let me see what URL is popular for hacking. Okay, yeah, so for example, let's say I'm a hacker, right? And most people will go to Binance.com, right? You can trick somebody by having something that says BinanceC.om. And if somebody's not looking, they'll get you, right? But a real smart hacker will find something that is hard to tell what it is, right? So let's say we have Binance.com. Let me just save this. I'm trying to see what website would be good for this, because hackers can use other characters that make it appear legit. So for example, it's common for anything with like a capital I and a capital L, I mean, and a lowercase l, look exactly the same. And just think about that. A capital I and a lowercase l look exactly the same. So a smart hacker could switch those two in the domain name or even in the email and you think you're going to the actual site, and you end up getting hacked, right? How do you prevent that? One, always double check the link you're going to make sure it's legit. What I like to use is actually SimilarWeb plugin, right? Because if you're on any big site, any large site, you know they get lots of traffic, right? So if somebody took me to the wrong Binance site, I would see that this site gets no traffic. That would tip me off that this is the wrong site, right? Because Binance they get almost 200 million visits a month, right? So if you go to some site and it gets nothing, it's completely unknown, right? So for example, if we go to Ifani, right? Ifani has nothing, right? So this will tip me off, right? So that's one aspect. Then I highly recommend you change your DNS to a DNS provider that filters out for phishing and malware attacks. This is now getting kind of advanced. There was actually one in the book that was by IBM. It's 9999, basically 4 nines. Yeah, quad 98, right? This is totally free, but what they do is using a DNS is basically a domain name server. It's basically, think of it as an address book for the internet, right? When you put in, because the internet is allocated via IP addresses, but nobody actually types in IP addresses. You put in a domain name like Binance.com, which then results to an IP address. So that is done via a DNS, a domain name service, whatever. But not every DNS vendor is created equal, right? Quad 9 is the best out there that I've found. If you know any better ones, let me know, right? Basically, they actively filter out phishing and malware attacks, right? So they have a huge database of phishing sites that they block. They won't even let you go to them. So let's say somebody is smart enough to trick you via a phishing attack via email. You click that email. If it's in their database as a phishing site, it won't even load, right? So the hacker gets nothing. So I highly recommend you leverage this if you're in crypto, right? So, and they update this every single day, right? And there's a short video on how to set this up, right? For Windows and Mac. If you have this, you're halfway home in terms of securing yourself in crypto, right? Then the other aspect, let's see here, is getting hacked via your network, right? So this is the tough pill to swallow about just being on the internet, right? Everybody gets hacked without even knowing it. Right? Well, not everybody, but a good portion of people get hacked. If you take any device and put it on the internet, within a few hours, you have what they call automated port scanners that go through and scan just the whole internet. Scanners can scan the whole internet in 3 to 5 hours, but let's say 3 hours or 4 hours, right? So you can have an automated bot that can go through trying to hack every IP address in the whole internet in 4 hours or less, essentially. So anything that goes online has already been scanned and can get hacked, right? So how do you prevent that? Well, you should definitely get a firewall if you're going to be on the internet, right? Now you can have a software firewall, but an even better option is a hardware firewall. Hardware firewall that has what's called deep packet inspection filtering. Basically, it's not just protecting you from getting hacked via software, but even through the router at the hardware level, right? So now this gets somewhat pretty advanced and pretty techy, so without trying to lose everybody. The one I recommend in the book, now the one in the book, honestly, there's several in the book, but the one I've used is pretty advanced and it's very technical and it's open source, but hard to set up. So if you're on a techie, do not use that. Let me see which one it was. Yeah, I used the Netgate SG. Let me see which one I use. Actually, not that one. I used so you can, depending on how many devices you have at home, a good one to use is Netgate 3100 PF Sense. So basically anything that supports PF Sense. PF Sense is basically software for your hardware firewall that's open source. But because it's open source, it can break often. So if you're on a techie, I would avoid that. You can even find other hardware firewalls. Let me see. Hardware firewall. But basically anything that's enterprise grade is more than good enough for you in crypto, right? So, actually give me 1 second. Let me check Amazon. Okay, so I'm going to Amazon. I put in hardware firewall. Let's filter for anything over 4 stars. Yeah, so all these are different options that are pretty good. If you're not tech savvy, there are simple ones like Protectly is pretty good. I think that one I covered in the book. Sophos, this I've not used, but Sophos is the virus company for Macs. Ubiquity is also pretty good. But basically, you want to find something that's pretty good. All right. There are some firewalls that are simpler. I think Symantec has some. Symantec, however that's pronounced. Symantec. Yeah, so like this firewall is pretty easy to set up, I believe, when I last looked at it. So for those who aren't so tech savvy, this one can manage. Or what you can do is just call an IT guy and have them set everything up for you. Now that's not ideal because then you have an extra risk element, and that if you have a rogue IT guy that hacks you, right? So, but if you trust the IT guy, if it's a well-known company that's reputable, just do that. Just tell them you want to have a hardware firewall, and they can do that for you, right? But basically, deep packet. The reason why deep packet DPI is vital, it basically filters through every single byte of traffic going between your computer and your router and the internet. That way, if any hackers tries to have any malicious code, like let's say a phishing site that tries to hack your computer or whatever, the DPI can block that at the router level. Like it is that good. Like that's what enterprises use. Now, obviously it's not perfect because even enterprises get hacked, but all these are extra layers of security we're adding. Right, so I definitely recommend having Quad 9 for DNS and having a hardware firewall that supports DPI. Okay, so now let's go back to the book. Okay, so social engineering attacks, right? Social engineering, what is that? It's basically, you can have all the best security in the world, but if you're not smart with the brain, somebody can get your information just by tricking you, essentially, right? So basically think of social engineering as using the internet, spies, whatever, right, to get information from you, right? And this is probably a common way that most people do get hacked, right? What's an example of a social engineering attack? In terms of companies, it's somebody just pretending to be an employee, going to the company offices and just asking for information, right? So if you're interested, one of the books I read as a kid is a classic, Kevin Mitnick. He's a famous hacker, that was known for social engineering, right? If you want to read more about that, his book called The Art of Deception, right? Controlling the human element of security, right? Basically, social engineering attack could be, imagine somebody calling up your phone company, pretending to be you, right? And having them port their phone number to their new phone. You think it sounds like it won't happen? It happens all the time, right? Like Michael Turpin, I think it was a social engineering attack. He got hacked for over 25 million, unfortunately, via AT&T. And AT&T has a bad reputation for getting hacked all the time. Right? I mean, I would if you have AT&T, I would switch. I would get a funny. I would do whatever. But AT&T has a bad reputation for people hacking them all the time. But this is an example of a social engineering attack, right? I mean, how many times? Because most people don't really check or verify whatever you say, right? So most social engineering attacks happen via phone, with people pretending to be you, right? If somebody can call any vendor and pretend to be you to get information on you. That's basically what you do, right? And the ways to protect against that is to have 2FA on everything, call the phone company, whatever you have, and now have them add a PIN to your account that prevents SIM swaps or phone transfers without your permission, or have a PIN. Actually, here's a good example. I know somebody, a YouTuber, who almost got SIM swapped, right? He had a PIN on his account with his phone carrier that prevented anybody from calling in and having his phone number ported, right? He had a PIN, he basically had a setting on there that you could only do it in the store. Like, guess what? This hacker went to the store and tried to tell the store he was just YouTuber to have them transfer the account, right? The good thing is the store employees didn't fall for it, right? But imagine if they did, right? Because they asked them to show ID and everything. I was like, this person does not match this person, right? But hackers will go to extreme lengths to get your crypto, right? So before we even start, prior to even talking about investing in crypto, we have to make sure we're not going to lose our money, right? Through bad means. But essentially, that's social engineering. And let me check the comments here. Hey, what's up, Cello? What's going on? Is there a way to get internet from different source? I mean, in terms of ISP, yeah, I mean, so the other part I haven't covered yet, which is a good segue, VPNs. If you're on the internet, you gotta have a VPN to use, right? What is a VPN? Virtual private network. But basically, a VPN changes your IP address when you're on the internet, right? So basically, it conceals your IP address. That's basically all it does, right? There are lots of good VPNs out there. The ones I like, that I recommend, I mean, I use several. So there's private internet access. Let me pull all these up. PIA. There is, which one do I use? Because I have a bunch of them. So because I travel a lot for crypto and the world, and not every VPN works in other regions. So like, there's one VPN that works in China. If you're in China, there's one that works in other places of the world. But essentially, here I'll just cover PIA, right? NordVPN. I haven't used NordVPN, but I know people who trust it. I've used PIA. They do take crypto as well, but basically, it protects your privacy, right? It secures your data, and the main thing you're looking for a VPN is one that does not store your logs, right? So one doesn't store logs, and one that is good. So there's private internet access. There's Express VPN. I think this was the one that worked in China when I was there, because in China they block lots of VPNs, right? So there's one here for if you want to look into that. Then there's one other one that I use, because the one I use, let me see if I can look it up. Just give me 1 second here. Yeah, so there's also iVPN. iVPN is pretty good as well. This is the one I mainly use, right? You can create an account, but basically all of them are pretty much good, as long as they don't store your logs, and they have different regions, and they have fast speed, and they also have like anti-tracker functionality here. They also have their own firewall, right? Now, if you want to get super advanced, you can even run your own VPN, right? Basically, if you have your own server, you can run your own VPN. You can do that through, for example, like DigitalOcean. DigitalOcean VPN. I think Yeah, so if you want to run your own VPN, you can do that through DigitalOcean. This is if you're techie. But yeah, running your own VPN in crypto, having VPN is needed in crypto, right? But basically at a high level, that's how you secure your crypto from hackers. Okay, so now we're finally going to talk about how to actually invest in crypto, right? We've been going on for what, over an hour, and now we're finally getting to investing, right? So this is definitely a masterclass. So if you're enjoying this class, definitely smash the like buttons, share this video with a friend, tell a friend to tell a friend, not investing in crypto, and not buying the book, or even just getting the free book, right? Or the audio book, right? For those who are just joining, we have the audio book on Audible now. It just came out. And also make sure to go to tokenmetrics.com if you haven't already, and you sign up to get 25% off with a holiday code, TM Holidays. Go here, sign up. Code is TM Holidays, one word, all caps, and get Tokenmetrics. We're a data analytics platform that helps you become a smart investor using AI. Okay, but now let's go to the basics, right? Introduction to value investing, right? So I don't really need to bring that up here, right? What is value investing? To understand value investing, it kind of goes hand in hand with fundamentals, but essentially value investing is finding an asset to invest in that is undervalued. Let me repeat that. That is crucial. Finding an asset that is undervalued relative to the market, right? That does not mean finding a great asset. It's finding something that is undervalued. Something can be total garbage, but still be undervalued. Once you get that, you'll get value invested, right? So, for example, let's say that we believe, this is why I was able to see the whole Ethereum trade play out, because my philosophy is Ethereum will flip Bitcoin. Not a matter of when, not a matter of if, but when, right? And this was so easy to find out. So I sold all my Bitcoin, pretty much, back in 2018, and I've not looked back. And the reason being, I'm a value investor, right? If I had to pick one category of investing that's my bread and butter, it is value investing. And the premise begins like this. We have Bitcoin being a store of value, basically digital gold. The market cap of gold is, let's say, 10 to 15 trillion. And we have Ethereum building the next internet, Web3. And to me, the total addressable market for the next internet is much bigger than digital gold, because the next internet is Web3. If you take the whole internet, and if you could take that and make that a stock and invest in it, that's huge. Because just think about it, just DeFi by itself, DeFi, decentralized finance. Basically, take everything, take all capital markets and tokenize them and make them digital. Derivatives is, by most estimates, worth over $500 trillion. If that gets tokenized, it's happening on Ethereum. In this case, probably with L2 scaling, with layer 2 scaling, because right now Ethereum has issues with transaction fees, but that's a different story. So $500 trillion just for derivatives, just for DeFi getting tokenized, is much bigger than digital gold, right? And most of DeFi, at this point, about 75% of DeFi is happening on Ethereum. Yes, you have other blockchains that are competing, Solana, Avalanche, Phantom, whatever, but Ethereum still dominates. Because if we go to, what's that site? Give me a second here. There's this website that I used to go to. DeFi Llama. Right, so if we pull up DeFi Llama over here, this shows us the total value across several blockchains, right? And okay, Ethereum has declined, but basically 63% of DeFi is happening on Ethereum. Then we have Terra Luna at slightly under 7%, Binance Smart Chain, Solana, right? So other blockchains are coming for Ethereum, but over half of it is still happening on Ethereum still. And this is prior to ETH 2.0 actually launching, right? So my thesis was Ethereum, because Crypto Tiger says DeFi Pulse shows better results. DeFi Pulse is also pretty good, but the thesis is this: Ethereum is undervalued, and at that time, Ethereum had 10 times the monthly developer activity of Bitcoin. So when you find a crypto asset that has a larger total addressable market, that has a lower market cap than Bitcoin, that is growing at a faster rate than Bitcoin, basically the fundamentals were telling me that Ethereum was grossly undervalued. So why invest in an asset that's overvalued, right? Value investing is as simple as buy low, sell high. But how do you determine what's low and what's cheap? You look at the market, right? So, for example, one of my better investments ever, Helium Network, just totally crushed it. Helium and Polygon, all right? So if we go to CoinGecko, I'll show you why Helium was, as close to a guarantee as you get in crypto, right? Because we can't really make guarantees, but I haven't met anybody who didn't make money on Helium. If you're with us day one, back in the day, because think about it, right? Helium was building a decentralized internet, right, for IoT. That was a huge market cap, right? And the way I compared Helium back then, even though they're kind of different coins, I compared Helium with IOTA, because IOTA was so overvalued, right? And the market cap was 3 billion, right? And we're covering Helium 1 year prior to them launching. And we even did a deep dive report on them when they were around 20 cents. The price now is almost $40, right? You guys can do the math from that, right? But basically, from 11 cents was the all-time low. That's a 251x. The all-time high was $54, right? But imagine the market cap of Helium when it launched was very low, right? You could have basically, on exchanges, it was under $10 million market cap. So here you had a blockchain, right? That's important, right? Because historically speaking, blockchains have, layer one blockchains, historically speaking, have fared the best. They've had the best return on investment over infrastructure projects, over applications, dApps. L1s make the most money. So here you had an L1 chain that was very innovative, first of a category. There wasn't really anybody out there competing with them. That was valued at under 10 million. And then you had this other project, inferior technology, kind of doing IoT. That was, because the market cap, what's the market? I'm gonna switch to, yeah, the market cap back then for 2020. Let me just double check. Because we're comparing basically spring 2020, it's like May 2020. Right? Basically it was over $500 million. I said to myself, superior technology, and because the thing about Helium, you had to mine it to earn it. There was no token sell, except for like VCs or whatever, but that's a different story. You had to mine it. So the initial market cap was super low. And I said, where can this go? Where can Helium go? And to me, it screamed 100x. Let me see if I can find the report we did on Helium. Right, to show you that this, when you're a value investor, you can find these plays that are undervalued. Right, so this is the report we put out. Right, this was a deep dive. This is, if you haven't joined Tokenmetrics, this is why you should join us, because we do reports like this. And now we have all this automated through live ratings. Right, but basically this is the report we did on Helium. Right, and if you go all the way to the end, right, this was almost 40 pages. Actually, this is the video of me in the offices back in 2019, one year prior to their launch. Yeah, so this is me comparing it. So we compared Helium to IOTA and to Hollowport, because Hollowport by Holochain also had some device you would buy and basically mine or store the internet, and we compared the two, right? And the fundamentals were there. They scored high on a fundamental grade. Basically, we go through looking at data points like the team, their background, the use case, and other metrics. We make them as objective as possible as we can, and we score them, and they scored very high on the fundamentals. And basically, the conclusion was Helium Network is our top pick for low cap projects with huge upside potential to deliver 100x returns, right? And the reason being, right, so we covered it, or this report came out when they had about 3,000 hotspots. Market cap was 8 million. IOTA was 500 million. Holochain 100 million, right? And the downside was low. You basically would buy the device for $400, plug it in, and begin mining, right? And people were earning 5 HNT tokens a day. And the price at that time was 22 cents, right? And in terms of, let me kind of bring everything back home, right? Because I've kind of been going all over the place. To understand value investing, you have to take an asset that you're researching, in this case Helium, and compare it to similar assets and see where the market prices them, right? So here we found something that had better technology than IOTA, better technology than Holochain and Hollowport, and anything that was somewhat similar, yet had a valuation that made no sense. That by definition is being undervalued. And when you find something that is that undervalued, that is a home run. That is where you back up the Brinks truck. And because with this, you would just buy the device and mine. So it's like mining Bitcoin back in early 2013. So to me, the downside was losing $400 or $500 on a miner, and that was it. Maybe some power, but I didn't really care about power, right? But once you see something is undervalued, you can then use that to double down and place a bigger bet because you have the confidence to swing for the home run, right? A different example is Polygon. I think this might even be a better example, right? So we covered Polygon after we met them in Hyderabad, India during our Crypto World Tour event in 2018. So I was in Polygon when it was under 3 cents, but back then it was called Matic Network. But when they pivoted from being just Matic Network to Polygon, this was about a year and a half ago? Yeah, it was almost 2 years back, right? They basically pivoted to being the internet of blockchains, and that was the category they were in. So what I asked myself, because when they did this, their price was around 8 to 10 cents. And that same day I doubled down and bought a bunch of Matic Network or Polygon at 10 cents. I bought even more. Because I had some under 3 cents, I was staking that, but I went not all in, but it became a large part of my portfolio. I think when they changed to Polygon, it became probably my second largest holding, because then it was super undervalued. Basically, the fundamentals shifted it basically became the internet of blockchains on the Ethereum network, right? What does that mean? Because basically, the internet of L2 scaling, layer 2 scaling. So you have basically the Ethereum network, then you have a layer 2 network, which is basically a blockchain that is built on top of, or being secured by Ethereum, but basically it's a side chain almost, or a different blockchain that is tied to the Ethereum network. And you have all these other different blockchains that are working together with Ethereum to help offload transactions to have them run a lot faster. For example, for gaming, for NFTs, for metaverse. But at a high level, they're trying to offload transactions to help the Ethereum network run faster, right? Because you can run games on Ethereum network because the transactions per second do not support gaming. So you have a different blockchain that has a lot less security, that can run a lot faster, but then gets secured by offloading transactions onto the Ethereum blockchain. But now you have so many other competing different layer one, so many other competing L2 chains. How do you know which one to use? This is where Matic comes in, right? It's Ethereum's internet of blockchains, right? And the chains they support, where is this? Right? They have ZK rollups, optimistic rollups, enterprise chains, Polygon Plasma, Polygon Proof of Stake, standalone side chains. So you as a developer, you don't have to choose. You just use Polygon and it will pick which one it thinks works best, whatever, right? But the reason why this became undervalued just by changing their use case, because the total addressable market became bigger. Because now I said, okay, if they're going for the internet of blockchains, what other similar blockchains out there is it now competing with? And at the time, it was competing with, if you go to, just give me 1 second here. I'm actually log into Token Metrics. And this is going to be a long masterclass. All right. So, okay, so this is Token Metrics. All right, so I asked myself this, because as a value investor, this is the main question you ask. What competing projects have a similar use case? So use case for Matic or Polygon was Internet of Blockchains. And then once you have the list of similar blockchains, what is the market pricing those blockchains at? Right? So we had Polkadot, market cap, 33 billion. We had Avalanche, 27 billion. Because back then, Polygon was hovering between 90 and 100 market cap, right? We had Cosmos, 8.5 billion. And was there any other? Icon wasn't really there, right? But basically, those were the three projects. Because back then, Matic's market cap and valuation, market cap equals valuation, right? That's what the market is pricing that at. Meaning that if you take all the tokens for Matic network and you multiply them by the price, basically if you take the circulating supply times the price, that gives you the market cap, the valuation. If you take all total tokens, even those that haven't been minted yet, and you multiply that by the price, that gives you the fully diluted valuation or market cap, right? No, you want to use both as an investor, right? As a value investor. But in this case, I used just purely the market cap, not the FDV, right? So for instance, looking at this now, right? Market cap for Matic or Polygon, about 19 billion. FDV, fully diluted valuation, 27 billion, right? But at the time, market cap was 500 million, but competing projects were getting valued at a minimum 5 billion, right? And the lowest at that time was Avalanche at 5 billion, but Polkadot was like $20-30 billion range. I asked myself this, right? Is Polygon or is Avalanche 10 times better than Polygon? The answer was no. That meant to me Polygon was undervalued, right? And then same thing with Polkadot, right? Because our team goes through and does objective ratings across the board, and we had rated Polygon's technology on a scale of 0 to 100 as an 88. We had rated Polkadot as a 94, and Avalanche at that time was like a 78 because it was relatively new. And I felt at the time that Polygon had better technology from talking to our developers, but the valuation was a tenth that of Avalanche. And I said, okay, so basically you have the first of a category. You have first, second, and third, right? When you have first, second, and third, you then project out the asset you're looking at and say, okay, if this has better technology, where can this go? And to me, the minimum was flipping Avalanche and being third in that hierarchy. So to me, that was a 10x. So as a result of that, I saw that Polygon was undervalued relative to its competition, in this case, Avalanche and Polkadot, right? Because Polkadot was going for 20-30 billion. Why can't Polygon flip from $500 million to 5 billion easily, if not 15 billion, right? And that's how you value invest. You basically find great assets, great investments, but what matters about value investing is the price you pay for them, the valuation you pay for them, right? So for example, technology-wise, Polygon is great, if not even better than before, but would you buy it now is the question, right? This is what tricks up people who don't get value investing. Value investing is not necessarily about finding a great asset. It's finding something that is undervalued. And that is why Bitcoin is great technology, but it is not undervalued. Yes, it is undervalued relative to stocks. But in terms of the entire crypto market, I think there are other investments that are more undervalued than Bitcoin. Ethereum, heck, even Polygon is more undervalued than Bitcoin relative to market cap, right? What's more likely to happen? Bitcoin doing a 10x or Polygon doing a 10x? Or Helium doing a 10x, right? So those are the questions you have to ask as a value investor. What are competing projects in the space? What is the market pricing them at in terms of valuation? And that's what you're looking at. Is it better than those projects? If it is, what happens if it flips and becomes the third in the hierarchy, the second or the first? When that happens, that gives you the valuation range, right? So for instance, if we go back to token metrics and we'll pick a coin, all right, this is where the scenario modeling does help. So if we pick Polygon, I think this should be at the price predictions tab, right? So this helps with that, right? So for instance, right now, in terms of, if you take the market cap for Polygon and divide by the market cap for the whole market, basically it's slightly under 1%, about 0.8% dominance, right? Now, if you think the dominance of Polygon will increase, right, what market cap does that give you? And what price would that be, right? So this basically is a chart you can use for that. But for me, I like to kind of just look at it from a very simple perspective. What are the top 3 projects in that sector or category? If this has superior technology, where can it go? Basically, the minimum is the 3rd place, the maximum is the 1st place. That gives you the range for valuation. And for me, as a value investor, I like to find investments that will give me a minimum of a 10x return, right? To me, that's my definition of being undervalued. Meaning that textbook Polygon at $500 million valuation, a 10x, right, from that valuation is $5 billion. It would be around the same valuation as Avalanche at that time. This was slightly less than 2 years back, right? And that's why I knew Polygon was undervalued, and I was able to double down and buy even more. All right, so that is value investing. Okay, so now let's go to risk management. Let me just check in the comments here. Jan says Matic is still undervalued. Yeah, I think so as well. Thank you, Ibidiran. He's saying respect for the house. Yes, so thanks to Matic and Helium, and just crypto in general, I was able to help buy my parents a house, right? Their dream home, which was no easy feat. It was over $1 million. But crypto, generational wealth, right? That's what it's about. Okay, all right. So definitely go buy the book or get the free book on the site, the ebook. Get the audiobook as well. Leave a review. Tell us what you think. All right. So now, risk management. All right. So this is a pretty technical chapter. I'm just going to try to simplify this from my perspective and go through how I view risk. All right. How I view risk. Okay. Sorry. Jen says got into Matic at 1 cent. That's what's up, as we say.
We just landed on the moon in the Lambo.
Okay, all right. So risk. Oh man, risk. Risk is how people get wrecked in crypto, right? I mean, the biggest L in crypto happens for people who have poor risk management. You can have the best research in the world, tokenmetrics.com, or our channel on YouTube, but if you don't know how to manage your risk, you will get wrecked. Because, I mean, the first rule about investing, as Warren Buffett says, is not to lose money, right? But in crypto, it happens all the time. People lose money. But you have to live to fight another day. How do you manage risk? I mean, there are different ways you can manage risk, but for me, I view my portfolio like this, right? I think to have a fully diversified portfolio, right? The first element of risk is diversify. Right? Don't only invest in one thing. Right? Have different things you have invested in that are uncorrelated, ideally. But prior to getting to all that, let's just say, what is the ideal threshold, right? So from doing there's lots of research on data on this, right? The good range in terms of stocks, the good range for quantity of stocks to hold is 10 to 30 stocks, right? You want to have ideally more than 10 stocks in your portfolio, and ideally less than 30, otherwise you're becoming just a market index fund, essentially, right? So taking that same theory and applying it to crypto, we have the same concept. I think as an investor, you should hold more than one asset, right? Unless you're super bullish and you've done the research, and even then, I'll still diversify with a few other investments, right? But for me, the range is to have minimum 10 crypto investments in different cryptocurrencies and maximum 30. But 30 to me is way too much because you have to know what you're investing in, at least at a high level, but ideally on a deep level, right? And if you have 30 investments, you're just gambling, essentially, right? Because the real home runs, they happen with strategy, and think of yourself as a sniper, not just as don't shoot and spray. You want to snipe and find the opportunity for investing, right? So let's pick a middle ground and say 20, right? So let's say you should have max 20 cryptocurrencies in your portfolio. And by the way, all this is not financial advice, guys. This goes without saying, right? All this is not financial advice. Do your own research. But anyway, so I think 20 is a good range in a bull market. Maybe 30 is the max, but that's pushing it. But in a bear market, I'll probably bring it down to 10. But anyway, let's say 20 investments. Let's say you have $10,000 in crypto. I mean, like you have to invest in crypto. How would I invest that money? I would say, okay, if we're doing 20 investments, that's 5% in each cryptocurrency, right? That's a reasonable approach. That could work. And I think, if anything, that's a decent approach, right? Because most people I've seen who lose money in crypto, they're gambling. Even though they have, because the thing about this, right? Investing in crypto is still volatile, it's still risky. And even the best investors take L's, they lose money. I mean, think of this, when it comes from venture capital, a great VC in venture capital has a success rate of about 10%. Maybe 15, 20% if they're lucky, right? Basically, for every 10 investments, they anticipate that they will lose money on 8 of them, and 1 or 2 investments will return the whole fund and then some, right? What does that mean? That means that all the top VCs like Andreessen Horowitz, A16Z, all the VCs, if they make 10 investments, they don't expect every investment to be an Uber or an Airbnb or an Amazon or Google or Facebook. They expect that for every 10 investments, only 1 of them will be an Uber or Airbnb. And the rest will just either not make money or be neutral or flat, no exit. But the return of those top 1 or 2 investments will probably 10x the fund, right? So let's say you have $10,000, right? Don't view it as you're trying to get a 10x on every single investment, although that is a goal, right? Despite all the research we do, all the framework we have, we'll still know that there'll be L's, right? Armor Finance, for example, and others. But the best investments, those that end up being home runs, the Matic networks, the Helium networks, right? They deliver so much money, you don't even think about your L's. So in essence, you want to divide your portfolio. In this case, let's say 10 to 20 crypto assets, and then pick a percentage you won't go over, and then use that, right? So in my case, my portfolio, beginning of the year, was essentially, I was trying to get up to 20 coins, and the most I would put into any coin, especially those that were low cap, was 5% of my portfolio, right? So in that case, in the case of having $10,000, that would be $500 into any crypto asset. But you can shift the percentages and have a different factor for weighing that. So in our case, we use the TM grade, right? But at the same time, you want to make sure what you're investing has no correlation. So let me pull up our indices here. I think this is a good segue to help understand risk. Right, so give me 1 second here. All right, so at a high level, for those who are new, token metrics, we take our ratings. So basically using our AI, we go through and we rate crypto assets. We have over 3,000 crypto assets. We take those ratings and then we build a portfolio that tries to diversify those holdings, right? And minimum is about 5 coins. Some have up to 10, right? In this case, the KuCoin index is the best performing one. But why not just have an index or a pie chart with all tokens that have the best rating? Because correlation. Correlation is a risk that you have to factor into your portfolio, right? Ideally, you want to have a portfolio where if one asset goes down, you don't want the whole portfolio to go down. Because that means there is no upside in having assets or holdings in your portfolio that move the same. Then, because you're basically holding the same thing, right? So, for example, if we go to Ethereum and we go to the correlation tab for Ethereum, right? So, if you have Ethereum, these other crypto assets have the same correlation as Ethereum. So we have Ethereum, which is basically compound Ethereum on compound. Staked Ethereum, obviously that has correlation. But guess what? Binance Coin, BNB, FTX, Stacks, and Cardano, and Elrond. Right, so think about this, right? If you have a portfolio, it makes no sense if you have 10 coins or 20 coins to have both Ethereum and Binance and FTX or Waves or Stacks or Cardano. Because, I mean, the exchange coin makes sense, right? If Ethereum is doing well, people are trading DeFi and all that, exchanges will do well as well, right? So for every holding you want to have holdings that move the opposite. It sounds kind of funny about it, right? But it makes sense because when Ethereum goes down, all the exchange coins will likely go down, right? Because correlation is a scale of -1 to +1, and zero being neutral, -1 meaning negatively correlated, meaning that when it goes up, it goes down, and vice versa. And a +1 means it's highly correlated, meaning that when Ethereum goes up, Binance goes up, FTX goes up, right? Why does that matter? Because if the whole market goes down, and you have all these coins in your portfolio, your whole portfolio goes down. But you can hedge that. Now we're getting towards hedging. Hedging means basically trying to have a backup plan, an option, insurance. So in this case, lowest correlation you have here, crypto.com, -0.28. This is top 100 market cap, right? And you have the graph, right? So a portfolio that has Ethereum and Cardano, in this case, if the whole market goes down, your whole portfolio goes down, right? But if you have, let's say, Ethereum and the graph, or crypto.com, for example, right? If Ethereum goes down, crypto.com actually will go up, or is more likely to go up, helping boost your portfolio. So by managing risk, you are essentially looking to hedge, right? So if you have assets in your portfolio, you want assets that all don't move together, right? So for example, Helium, let's go to Helium Network. While Helium has been such a great investment, it's not really been correlated with the market too much, right? Looking at this, okay, maybe it has this changed? Yeah, so it looks like this has changed. But I would say last year, Helium was acting almost like a stable coin. When the market would go down, I think ever since they did the halving with staking and mining. This has changed. But in the past, when the market would go down, Helium would basically just not go down because people were printing money mining Helium. At one point, I was making $6,000 a month mining Helium. So why would I sell it during a market crash, right? So finding these assets that move in opposite ways helps remove the risk, right? So ideally, when you have a portfolio, you want the correlation of your total portfolio to add up to zero, right? That's typical finance. What does that mean? So if you take all the assets in your portfolio and their correlation, ideally it should add up to zero, right? So in this case, you take 0.96 and all this, and ideally you want to have other assets that balance it out and it goes down to zero. When it goes to zero, you basically have a market neutral portfolio, meaning that a portfolio that is not impacted by the market, bull or bear market. It basically it will just do well regardless, right? It's basically an all-weather portfolio. That's a common phrase by Ray Dalio, right? An all-weather portfolio. Now, when it comes to risk in crypto, there are so many elements of risk. You can do all the best research in the world and still get wrecked, right? So at a high level, if I go back, so how do I go about finding a cryptocurrency to invest in, right? We talked about value investing, right? But now let's manage the risk, right? So let's say I wanted to buy Helium back then when it launched. How would I go about it, right? I managed the risk by buying a hotspot that cost $400. Didn't lose too much money on that. And then when I was buying it at a low valuation, right? So when you buy something that's undervalued, that has a good chance to do a 10x, you're managing the risk. And then when I bought it, I didn't go in and buy half my portfolio with HNT or Helium. That's how you get wrecked. Because even the best research, mistakes happen, right? Because going back to the premise that despite having the best research, only 1 out of 10, basically 10% or less of your investments will actually be home runs. You still want to have margin for error, right? And you do that by managing the risk. So for me, if something is a new asset, in that example, I will not invest more than 5% of my portfolio into that asset class. It's 5% or less. But as it starts to prove itself, then you can double down. Not financial advice. So for example, with Polygon, I doubled down, right? And with Helium, I doubled down, right? I bought Helium at like around 10, 15 cents, bought some more at around $1 something, bought some more at $10, I believe, right? Because success begets success. As a project proves itself that it's winning, as your thesis proves itself, you get even more confident and you want to double down on that. That's what I've learned this bull market cycle that I didn't learn last market cycle. And that's I think that's pretty groundbreaking actually, right? Because when something is winning, you want to hunker down, build a fort, start renting it out. I mean, you want to bunker down and go in for the long haul. Because if your thesis was right and it's playing out, you don't want to start taking profits too early. And I think that's what I learned this market cycle. But anyway, the other element I want to cover is liquidity risk. You can have the best investment, but how do you avoid getting rug pulled, right? Rug pull in crypto happens when something looks great. For example, Squid Game, right? Squid Game token that had that rug pull. Was this the one? It basically had a flash crash that went to zero. Yeah, that's right. There are reports of rug pull in this project and mainstream media. Please proceed with caution. Right? All right. So let's see what happened here. I'm not seeing the rug pull here though. Okay, I guess, was it here? It went here and went to. But anyway, a rug pull is basically a project that it's a pump and dump, right? They pump it, then it dumps, right? And in all markets for investing, especially in crypto, tokens go up in an escalator and they come down in an elevator. That's something you should definitely recall when it comes to investing in general, right? the faster they go up, they'll fall 10 times even faster, right? Because once you get that as an investor, you will get why you have to manage your risk. Because something could go up, something can take, let's say, 10 months to go up to do a 10x, right? Then lose most of the value in a tenth the time, right? So basically in a month. So it will take 10 months to go up, then a month it just crashes, right? Once you manage that, you will know why you have to manage risk so much in crypto. Best case, the best time to invest in crypto was during the pandemic, when Donald Trump announced that US was closing down its borders. I mean, I recall this day so vividly. I was up late at night as usual, went to sleep around 3, 4 a.m. Yeah, probably around 3 a.m. after doing some crypto and stuff. I woke up, I kid you not, at around 10, 11 a.m. The whole market had dropped 40%. In less than half a day, in less than 12 hours. I mean, there was blood in the streets. It looked like a freaking crusade. I mean, the block folio was just bleeding. Right, so basically, between falling asleep and waking up, when the music stopped playing, the whole market had dropped 40%. Bitcoin dropped like 30%, altcoins dropped 40% or more in less than 12 hours. That happens in crypto. Across the board, not just shitcoins, I mean, even great projects. Like creme de la creme projects were losing 30 to 40% of their value in less than 12 hours. Because people were on a flight to liquidity. People didn't want to be in the market if we're entering this lockdown, essentially, right? So how do you prevent that from happening? One, you diversify your portfolio. Don't put too much into every asset class, unless that asset is something that is super solid, like Bitcoin or Ethereum. I think those are the ones where you can make an exception, right? For example, like at one point I had about a quarter of my portfolio in Ethereum, right? Because Ethereum is not just a regular altcoin, right? And for me, there was more upside in that than Bitcoin. But liquidity risk, right? How do you handle that? So I take any crypto asset and I look at the trading volume. Let's not use this pump and dump. Let's use a different coin. So let's say RMRK was a project we've covered that did well on code reviews and was part of our altcoin quarterly report, right? So let's say I want to invest into RMRK, right? So its market cap is 375 million. Trading value is slightly under 6 million. Right? So basically I would just take these two numbers, if I can copy and paste here, and it's really this simple. And I would divide this by the market cap. Right? And I would just times by 100. I'm doing this on the search bar. Okay, why isn't this? Yeah, so basically 1.58% of the market cap is being traded every single day. What does that tell you? This tells me this is very illiquid coin. And when you're investing into something, you want to make sure you're investing into something that has liquidity. Because you always want to have the premise that the music can stop playing anytime in crypto, regardless of what asset you have. And it doesn't matter whether Bitcoin, Ethereum, creme de la creme, or shitcoin, they can drop 40% or more in less than 12 hours. So when that happens, you have to be able to get out very quickly. Right? So my general rule of thumb is I like to invest into projects where at least 10% of the market cap is being traded every single day. Right? That's in our ideal world, right? And ideally, not more than 50% of the market cap should be traded every single day. Why does that matter? Right? If you have a project where more than 50% of the market cap is being traded, that means you have lots of turnover, right? So this is actually the case with Bitcoin, I believe. That means you have lots of traders, lots of short-term holders. Right? People who are holding it don't believe in the long-term value of that. I mean, they could, but they're just traders, right? So in this case, Bitcoin not so much. I think they cleaned up the watch trading. But basically, you want to avoid coins that are being watch traded or coins that have traders in them. Because if people who are in that asset are trading it, guess what? When the music stops, traders will get out. And there's no liquidity in them, right? So my sweet spot is 10 to 50%, 50 of the liquidity, right? Now this is not necessarily a bad thing, right? So in this case, remark RMRK, right? This tells me that there aren't too many traders in this coin. If anything, it could be a good thing depending on how risky you are. That people in this coin are long-term value investors, right? And they aren't selling much, right? But it could also be, because looking at this, circulating supply is 9.5 million. Total supply is 10 million. So 95% of the coin is circulating, right? Looking at this market cap and FDV, fully diluted valuation. So there isn't going to be too much inflation or too many new coins introduced into the supply. So that's actually very interesting, right? Then we go to the markets, and now I see why there isn't too much being traded. There aren't that many exchanges. There's only Gate.io and KuCoin. So if anything now, this tells me, okay, there aren't too many traders in this coin. There won't be too much inflation in this coin. So the valuation is pretty much the valuation right now. Plus, if a new bigger exchange like Binance or Coinbase adds this can do pretty well, especially if this did a code review. So although this has a low trading volume, this would tell me this is actually a good long-term hold without looking into all the other technicals, right? Okay, but now how do I look at the actual entry point? The actual entry point is, the other general rule I have is, you take the trading volume, this is if you're a whale, and ideally you want to, whatever you buy should be 5 to 10% of the daily trading volume, the 24-hour trading volume. All right, so we take the same number, multiply by 0.10. So let's say I'm a billionaire or whatever, right? And you're trying to buy on exchanges. Not the best thing to do, but let's say you want to do that, right? Looking at this trading volume, I would not buy more than $595,000 worth. Ideally, I would buy even less than that, right? But this is basically the max threshold, right? Otherwise, you'd have lots of slippage. If we go back here, but let's say you wanted to do 0.05. Basically, you would not buy more than $297,000 worth. That's one way I would go about doing that, right? So basically, we're looking at the market cap, the circulating supply, the trading volume, and all that helps us figure out how much money to put in, right? So let me see if I can get a different coin that's a lot less liquid. Let me see what's. So if we go to homepage here, let me actually. Okay, so for example, let's look at one of the indices, right? So we have the KuCoin Daily Index. We have Chronotek. If we open this up here, with Tokenmetrics, market cap 134 million, trading volume 1.49 million, right? Same thing, right? I'll just take that times 0.05 to be safe. If you're a real risk taker, for example, with Helium Network, when it launched, the only exchange was some small crappy exchange, and I was so bullish on Helium that I was willing to do 10%, and that's how I sized my trades, right? So in this case, let's say it's as bullish as Helium, you would do $149,000 per trade. Now, the other alternative is to just buy this OTC over the counter. This is harder to do. The best OTC desks are typically at big exchanges. So Kraken is known for having a good OTC desk. Coinbase has one. I think it's typically for institutional investors. Helium Network had a Telegram group by just some random people that put it together. I mean, with stuff like that, you want to be very careful with buying OTC. Typically, it's better to do it through a well-known entity like an exchange. But that's how I would size my trade. So why is this valuable, right? Because it doesn't. The issue isn't how much money you have; it's how much you can get out. That's why I've rarely been rug pulled, right? Because every entry is calculated, and even the exit, at least for liquidity, is calculated, right? So in this case, we know, okay, let's say I'm not as bullish on this as Helium. I would only put in 5% of the daily trading volume. That way, if there's a squeeze, if there's a run to liquidity, I can get out easily. Not perfectly, but not as much as somebody who comes in here and buys the whole trading volume, right? Because this will affect the price either upwards or downwards if you buy or sell. But in essence, that's risk management, right? Now let me pause here and see if I have any questions. Roberto says, you said RMRK is not a liquid coin, but it's still good due to limited supply. Due to one, having good fundamentals and good code review grade, right? So based on our analysis, it passes the checkbox for good fundamentals and good code review, but it's not liquid, which makes sense because it's not really on any good exchanges yet. But if you're bullish on it long term, that should not deter you because you do anticipate other exchanges and liquidity getting better, especially if there's value in that project. And the good thing is, almost all the tokens are already in supply, right? So to me, that's a pretty good, not perfect, but a pretty good reason if you're a long-term value investor to consider getting in early. Not financial advice. All right, so chapter 6, I mean, man, we're gonna be here for a long time, all right? Okay, so next up, building a portfolio. So this we kind of covered this, right? So the last two is risk management and portfolio management kind of go hand in hand. So portfolio asset allocation, correlation. The long story short, we automate this for you with our indices, right? You come here, pick what you want. So if you want the weekly, like honestly, I would just use our platform because we automate everything using our data analytics and AI for you for whatever exchange you're on, right? So KuCoin, you can come here. We'll go through and find the assets that are at least correlated with each other, that have a high token metrics grade. So in this case right now, if you're doing weekly KuCoin, you have Polygon, Chronotech, Terra Luna, Yearn Finance, Aragon, right? And this is beating Bitcoin, as it should. But let me see, if there's anything else. Yeah, because this is a pretty, so I'll touch on rebalancing your portfolio. So in crypto moves fast. So when should you rebalance your portfolio? Because when you're investing in crypto, don't just randomly pick coins. View everything as a whole. You're putting a portfolio of assets together, and you want to see how those assets move and work in tandem together, right? And we talked about correlation. We talked about managing risk, but also you want to constantly update your portfolio, because if you never update your portfolio, you have new coins constantly entering the market that are better investments. So at what frequency should you update your portfolio? I think from our back tests, the best frequency in crypto is weekly, but that's sometimes too active for some people, right? If anything, I think monthly, but you should definitely be looking at your portfolio and seeing how often you should rebalance it. Rebalance means, should you take coins out? Should you add new coins? Should you take profits? But to make things simple, as you have different allocations, you want to take profits and rebalance to other allocations. So going back to our index, right? So looking at this index here, we have basically 25% of the portfolio for the weekly should be in Terra Luna, right? Once the week is over, we see what the next coins are. If Terra Luna is still 25%, let's say it goes to 20%. That means sell 5% of the portfolio, basically 5% worth of Terra Luna itself in dollars. And basically you're taking profits out of Terra Luna, and then you shift that towards some other asset class. Let's say Polygon drops out and some other coin enters. Then you basically do that, right? But the whole premise is you want to constantly be rebalancing your portfolio to adapt to market movements and swings, because crypto is a volatile market. Now, in general, daily indices fare better during choppy markets and bear markets and crashes and corrections. And then the long-term indices, weekly, sometimes monthly, but right now in the last 1 year or so, bull markets, weekly has fared better. But long-term, you have to capture those long-term rallies. And the daily does not really do that. So if anything, a good approach is long-term, weekly, monthly. If we're in a bull market, if we're in a crash, daily, because daily can get out of those crashing coins and go to stable coins pretty fast. So that's really it in terms of portfolio allocation and rebalancing. So that was a pretty short chapter. Okay, so now let's go to fundamental analysis. What is fundamental analysis? So you probably are familiar with fundamental analysis for stocks. So how do we apply this towards crypto? So for us, fundamental analysis is basically looking at the fundamentals of a project. So we have basically initial questions that we ask ourselves, because some questions are a deal breaker. Right? So for example, if the token supply is centralized, deal breaker. Doesn't matter what the fundamentals are, not ideal to get in, because the centralized people, the entities, the early insiders will basically dump on you, right? For example, XRP. I'm sorry, XRP Army, don't kill me now, right? But basically, if you have a token, a project that has 70% of the supply being owned by the team, and only 30% of the community owns the supply, it's not a decentralized project, right? So by definition, for a project to be decentralized, more than 50% of the supply has to be in the hands of the community. And what do we define as the community? We define that as the general public, basically non-VCs, so basically retail investors, and being anybody that can buy that asset on exchanges. So let me get some examples of projects. So in this case so for example, Matic, right? Matic has basically 6.8 billion tokens circulating, total supply 10 billion. So basically 68% is on exchanges, or can be bought on exchanges. So this is a community-owned project, essentially, right? And we said the same thing with RMRK somewhere. Right? RMRK, this is a very decentralized project, right? So 9.5, so 95% of the token is trading on exchanges. So there aren't really any insiders, and that's huge, right? If we go to XRP, for example, right, we have 47 billion and 100 million total supply. So only 47%. So this is a centralized coin. Now, you can't make money on centralized coins if you're trading it. But in terms of long-term investing, long-term value investing, I mean, basically the team can sell tokens and dump the market price whenever they like, right? Insiders can do it, right? And that is a deal breaker to me. So as I'm building a portfolio, I don't like to have coins in my portfolio. This is if I'm building a long-term portfolio where 50% of the coin is owned by insiders. Ideally, the community should own it, because this also makes it possibly a security and tougher to get listed on exchanges. And this at times is also called Ponzi-nomics, right? Where projects will launch. Let me see what example project has Ponzi-nomics. Give me, I think, ICP. So we have, like, ICP wasn't so bad. Was it Casper Labs? Casper Network? Yeah, so basically 30% of the supply. So 2.9, basically about 3 billion is in supply circulating and 10.5 billion. So while this had great technology, when it launched, I knew that this would not really do well. All right. If we go to, I'm actually use CoinMarket. Our charts aren't that good. Let me use Casper on CoinGecko here. Right. So even though Casper Network had great technology, it scored like an 88, 89, I believe. It had most of the supply was owned by insiders. And to me, that was a deal breaker despite having great technology. So that told me insiders will have to dump to take profits, and there's so much selling pressure, the price will go down. So as a value investor, you find a great project with great reviews, great ratings, and you wait until it's undervalued. So when it launched, it was overvalued, meaning that now's not the good time to get in. That does not mean never invest. It just means wait until it's undervalued. And if you look at this, from all-time high, it is down 90%. So if anything, we textbook call this in a way. Right, so it launched $1.33 and boom. And if anything, I would not touch Casper Network until, if anything, circulating supply crosses 50% or more. Despite having great technology, I want this to really be owned by the community. That way the community has most of the tokens on exchanges, and there won't be so much selling pressure on the token, which means that there's not enough pressure to cause a large correction or crash. So these are the other factors, the fundamentals you have to factor into besides just finding a great project, right? So because great projects can have bad tokenomics and basically token economics and just wreck you in crypto. So looking at this, even though the price has crashed, now's not a good time to get in. And essentially, that's one element of fundamentals, basically tokenomics, right? The initial question I look for is this a centralized coin or decentralized coin? If it's decentralized, that's good. If it's centralized, not good to even get in. Then market standing, liquidity. We covered liquidity. Market standing, so we look at the team's background. You want to find projects that have great teams, obviously. But how do you objectively measure that? The factors I like to use, I like to have projects that have public founders that are, you can invest in anonymous projects or founders, but that's more challenging, more likely to get rug pulled. So one element of avoiding a rug pull is not to invest in anonymous founders, especially pre-liquidity. Basically, don't do private sales, meaning buying a token before it's liquid or trading on exchanges. If it's an anonymous founder, that's tough, right? If anything, I actually learned that lesson through Integral. Going back, I probably would not have done that. But anyway, want to make sure the team is public, their background. They've worked for well-known companies. So for us, our threshold is, have they worked for a publicly traded company? For example, like Amazon or Google or Facebook. You want basically social signals of success. But we try to make it more objective or data-driven by saying the company has to be publicly traded or worth more than $1 billion. So that for us checks the box. And ideally, you want to have more than 3 people on the team or more, right, who have worked for well-known companies for more than 2 years, right? So for example, if a product is being launched by a Facebook engineer who did blockchain at Facebook for like 2 years, that's pretty good. that's a good vote of confidence on that project and that person. And if you have several people like that, for example, Facebook is Libra coin. Part of the dev team left and is now forming their own project. They raised money recently from some VCs, and that to me is a good sign, right? Because they come from a good pedigree. So if anything, pedigree is what you're looking for. Yes, it's not fair, but losing money is not fair either, right? So I want to limit losing money as well. And for me, looking for people who've done that, people who've had success. So for example, founders who've had past exits, that's a great vote of confidence. So for example, founders who've had a past exit for $50 million or more, or $100 million or more, probably in this market cycle, to me, that's a good vote of confidence. For example, Alex Mashinsky, CEO of Celsius. We rated Celsius highly back in 2018 because he's taken 3 companies public, I believe, that have had over $1 billion valuation. So like he's an all-star basically. So for teams, we're looking for all-star teams that we're willing to bet our money on based on their past success. We're not in the business of giving benefit of the doubt when it comes to teams in crypto, right? If anything, we have to verify and then trust, right? Then liquidity, we talked about. Reputation, have they been covered in well-known publications? For example, like Bloomberg, CNN, Wall Street Journal, right? They typically also go through and do their own due diligence. Have they been backed by well-known VCs? So a good list of VCs we respect in the industry: Multicoin Capital, Coinbase Ventures, A16Z. I think for me, those are the good ones. I mean, we have a longer list, but in terms of the best, Multicoin. Now we'll also be launching our own VC fund, our own fund, TM Ventures, Token Metrics Ventures, but that's launching in a month or so, or early January. But yeah, I mean, because VCs do have their own due diligence process, and by having that helps remove the elements of risk. Now you also want to add your own diligence process. You don't want to just blindly trust VCs, but it is a good threshold if a project has been able to pass the screening of Coinbase Ventures, for example, right? Then marketing development, how big is a community? Ideally, you want to have projects that have a great community. Products with no community don't typically do well in crypto. So community sizes vary, but whether Telegram, Discord, I think Telegram and Discord are the best avenues to measure community size. So you want to see a community that's actively growing. Actually, I do have this on token metrics. Let me see if I can. Like for example, if we go to Binance, yeah, so for example, right, Binance, right? So this is Binance's community. Reddit, we have comments per hour. So just go to any coin, then at the bottom, go to social tab. This shows you the average accounts active on Reddit, Twitter followers, right? So these metrics are pretty helpful, right? Because in crypto, you always want to look at the actual engagement, because so many scams in crypto, man. Don't take that out. So I mean, it's been known for products to just buy or have fake followers on Twitter, on Reddit, on Telegram, even Discord, right? So for example, if a project claims to have 100,000 people in their Telegram group, but you go and see the actual posts per hour, aren't that engaging, or they're lower than a project that has a tenth the size, then you know that they're bots, right? Or the community is not highly engaged. Sometimes it could be real people, but they're only in the group for a free airdrop. Once they get the airdrop, they left, right? Or they aren't that active. So you want to look at actively engaged community. So that's one other element you want to factor into your fundamental analysis. And then scarcity, right? So scarcity, scarcity talks about basically the supply. And at a high level, that's really fundamental analysis. All right, basically you're trying to find the tokenomics, right? Is it centralized or decentralized? Are there good social signals? Basically, are there votes of confidence? Are they backed by well-known VCs, well-known publications in the media? Is the team member, are the team members public? Do they have a past successful track record? That's what you're looking for when it comes to fundamental analysis. All right, now let's go to intro to trading. Now, I'm not really a trader. This chapter was actually done by Bill and our team. But in general, when it comes to trading, I'll just kind of speak to this at a high level. Most traders lose money. That's the data backs that up. Most traders lose money. And if you're going to be trading, you should always know your entry and exit before you start any trade. And you should have your rules, right? And you should have a system on how you trade, right? So Bill does Gantt charts, Forrest does trend line. So find a system that works for you and stick to it, right? You can learn how to trade for free. The course is out there. The one that I think is popular, I think it's pip trading. Okay, just give me 1 second here. Let me see if I can find it. Is it baby pips? But even Investopedia has a free trading course, right? Investopedia day trading course. Either that or it should be free. I mean, yeah. So I've heard some traders recommend this baby pips for trading. Okay, so this one, I thought there was a free course. Okay, this is not free, so. But I mean, I'll just buy the book. I mean, the book kind of covers that at a high level. But use TradingView for trading, right? So if we go to TradingView, if you're a trader in crypto, TradingView is the best tool to use. So let's go to Bitcoin here. All right, so trading is basically about momentum, right? At a high level, you have different indicators you can use. Without getting too advanced, you have moving averages, basically taking the price. You have a simple moving average and an exponential moving average. The most common moving averages that are used, I believe, are 50 and 200-day moving average. But you essentially want to ride the trend when it comes to trading. You want to you ride the momentum. Now, this is pretty much one of the reasons why we built token metrics. So you don't have to be an expert trader. If you come here to our technical analysis, we'll tell you when to get in, when to get out, right? So for example, we call the Solana trade. So if we go to Sol and go to technical analysis, all right? Basically, all this was using our AI. It turned bullish on Solana at $35 and got out at $200, almost a 7x return on a trade. This was a swing trade, right? A swing trade over several months, right? So when you're trading, you want to make sure that you know what time horizon you're trading. Either you're day trading, a day trader, they buy and sell each position within 1 day, basically in less than 24 hours. They never hold anything overnight after they're done trading. Or be a swing trader. A swing trader will hold a position over several days, but in theory, they also don't hold for too long. They aren't value investors, right? A trader essentially could be somebody who holds for as little as seconds to minutes, to as long as weeks to a month, maybe even longer. But for us, for example, we have a low frequency trading strategy. This is designed to not trade as much, right? To help you capture these large rallies, but to also help you get out of any crashes, right? So if we go to view profit and L, okay, so if we go to high frequency, this one does a lot more trading, but with trading, you have to factor in the trading fees you have from trading, because that does cut into your profit and loss. But if you're trading a lot, you could also get out of a huge crash, right? Then you have margin trading. Margin trading is dangerous. I mean, that's basically all I have to say on margin trading. Unless you're a pro, don't do margin trading, because margin trading, you can be right and still get wrecked. Right? So for example, I have a story, a friend of mine who shall remain unnamed, because in crypto will wreck you. He was trading on margin, Tron, TRX, of all coins. He was trading it, literally put in the order, walked away to go to the bathroom or whatever, came back, he was liquidated because Justin Sun had tweeted something that basically liquidated everybody. Now, to a point that he thinks Justin Sun did that on purpose because he was looking at the charts and knew what traders were doing and wanted to just wreck them. And so if you're trading on margin, if you're going to do it, I mean, make sure you know what you're doing, read up on it. If anything, manage your position. If anything, don't trade more than 1x leverage. I know people who trade 100x leverage and just get wrecked. And when it comes to options, same thing. If anything, I mean, options, our team has been looking into out of the money put options, basically buying insurance. Options, futures, all that. I mean, I would just say read the book. That's a very technical topic. And it's not my forte, so I don't want to speak on too much. But just learn to manage your emotions, learn how to hedge, have an entry and exit, know when to get in and get out, essentially, before any trade, and have a system. Remove the emotions completely out of it. And that's what I would say about trading. Okay, all right, let's move now to how to evaluate crypto technology. How to know if a project is real or not, right? So essentially, it's similar to fundamental analysis, but this is based on the actual technology, right? So at a high level, we have the following categories of tech in crypto or blockchain. You have layer one blockchains that are built for people to build upon. Right? They're the first base layer. Then you have layer two, which are other blockchains being built on. For example, you have Polygon being built on Ethereum, essentially. Or you have what are called infrastructure projects. These are protocols. These are not applications. These are designed for developers to use and develop that work with layer one blockchains, right? So an example could be a protocol like Chainlink. Chainlink brings smart contract oracles, for example, right, to Ethereum. And then that can be integrated with applications like Uniswap and DEXs. So historically speaking, layer ones make the most money. So Bitcoin is a layer one, Ethereum, Solana, Cardano, like anything that developers are building applications on, historically speaking, they've had the best returns on investment. So if you're looking to review those projects, look into that. But how do you know what's good and what's not? Because without being a developer, it is very, very tough. And the first thing we have to look at is GitHub. Because crypto is open source, we can go to GitHub and look at the code, right? But without being a developer, what do you actually look at? You can look at the data, at the analytics, right? So if we come here and look at a project like Ethereum, this is their GitHub page. And if we come here and look at insights, we can see how developers are voting on what blockchain will do well. So if we look at the last activity for Ethereum on GitHub, the open source repo, right, repository, this shows us how developers are actually interacting with Ethereum, right? So we have 29 authors that have pushed 47 commits to master, whatever that means, right? But let's skip that. Let's go to contributors, right? This is the activity in terms of how many people are updating or committing code to Ethereum, right? So we see the activity was early back in the day. It's kind of slowed down, right? But the two most important factors, although these somewhat can be faked, but it's still a good threshold, the number of stars, right? So basically, how many people have favorited this repository? basically how many developers are watching this, right? So we have 34,000 developers. Actually, I think we have this data as well. If we go to technology, right? So here we have basically how many people. So Ethereum has 34,000 developers watching it. Solana has 6,300, 6,000 basically, right? And then forks, I'm sorry, stars. Basically, how many people have bookmarked this? Then we have forks. How many developers have taken this code, forked it, meaning that they've copied the code and are now building something new with it. So Solana has 1,300 forks. Ethereum has 12,700 forks, right? Then going back here, watchers. How many people are actively watching all the updates on this, right? And then how many people are actually contributing, right? So 215 watchers, 231 contributors for Solana. And then this is just for us, just for token metrics. We've gone through and we've automated doing code reviews, right? So we try to automate everything. That's kind of what a platform does, right? For example, the bugs, security reviews, and all this. Using our software, we go through and do what's called statistical code analysis. And we try to automate and make this as data-driven as possible for anything that's open source that we have access to, right? So, for example, if we go to Solana stats, let me pull this up here in different repositories. Okay, that is not loading for some reason. Okay, I'll just go back to Ethereum, right? So we had commits. Then one thing to also do is, these are the most active developers for Ethereum in the last 1 month. But most active since Ethereum was born, it looks like, since 2014, right? So Jeffrey Wilke, co-founder, video game developer, co-founder of Grid Games and Ethereum and Gopher. Okay, based in Amsterdam, right? So you can go through and look at the developer activity and their history to see basically how reputable are the developers. Right? Ideally, you want to have somebody who has a long history, right? In terms of coding Ethereum, right? And then if they form any new projects, that's a pretty good sign, right? So if you go to the profile here, we have all the different projects they've worked on that are open source. We have their followers, right? So 1,200 followers. So he has a pretty large following for developers on GitHub. He has achievement here, whatever that is, but he hasn't really added any code in the last 1 year. Then same thing here. Okay, so looking at this guy Peter, he's pretty active, right? He's had 638 contributions in the last 1 year. So mainly commits, half of them are commits, 20% of pull requests, code review, and he's active on Ethereum, as we see here. And so basically, at a high level, without being an expert, right, in coding, just look at where the developers are going, right? Are there developers that are bookmarking this project? Are they forking and building on top of it? If we go here to community, again, not much there. Commits, right? This shows you the frequency of code commits. Right? So ideally, you want a project that is being actively developed on. You don't want a project that has not had developer activity in years, because that means there's no innovation being done on that project. Now, that could be fine if it's a project that's a currency that's done, for example, like a stablecoin, for example. But some projects do need actual innovation, right? So, for example, let's look at Litecoin. Right? This is why Litecoin gets a bad rap. First of all, the founder left the project back in 2017 because they didn't want a conflict of interest. Yeah, where is Litecoin? So what you can do is you can go to a project like either our site or CoinGecko will typically have the GitHub repo. Yeah, so this is their GitHub Litecoin project. Okay, so we don't have any insights for this. Okay, we have 8 people that are working on this. Shirley Lee. But not really getting much. Let me see. Okay, let's go to Litecoin over here. Okay, yeah, here we go. So look at the stars, the forks. So I mean, this project has been forked so many times. But if we go to the commits, not many commits. 0 commits, 0 innovation since it goes back to the whole year, basically. Nobody has updated Litecoin the whole year. All right, if we go to code frequency here. So last time Litecoin got any update was 2019. Is that a project you want to put your money in? I mean, why put money in a project like this when 31,000 other people are forking the project and innovating on that? All right, so if we go to forks, I think I have to log in here. Okay, all right. But yeah, I mean, so in general, you want projects that are being actively developed on. You don't want a ghost project. So first rule of avoiding taking an L when it comes to technology and crypto, avoid projects that nobody's working on anymore. Basically, they're abandoned projects. So you can check by looking at the GitHub activity. Ideally, you want a project that is actively being developed on by by commits. Then you want ideally a project that has well-known developers working on it. And I mean, for the most part, if you do that, you will avoid most of the L's. And then I would just say leverage token metrics and our code reviews. But at a high level, that's the basic stuff you have to do when looking into the technology of a project. Now, what if a project isn't open source? That's where it gets tough, right? That's where, I mean, it's really, you have to look at the background of the developers, right? So let's say we have a project that isn't open source, but we can find the developers on GitHub. Our blockchain engineer team will go through and research their activity on the GitHub and see the code quality. Do they write good code? Is it well documented, right? Do developers actually want to use this? Those are the elements we would use. Okay, all right, so moving on to the next chapter. Let's do a quick check-in here and see how we're doing. If you're enjoying this, please smash the like button, subscribe, and be sure to buy the book. We're doing a deep dive masterclass, crypto investing guide, how to invest in Bitcoin, DeFi, NFTs, and more. Audiobook just came out on Audible and Amazon. You can buy that as well. Crypto investing guide. Be sure to leave the review as well. Okay, all right. So, enter the token cells, ICOs, IEOs, IDOs. Basically, what is all of that and how do you invest in that? Right? So token cells is a better term now. Back in the day, they were called ICOs, initial coin offerings. Essentially, it's the first time a coin is being made available to purchase by investors. Right? So the first time it's ever sold to investors, and then after some time, it becomes tradable on exchanges. And if you buy, there are 2 ways to buy a token cell. There's a public token cell where the general public buys it. Then there's a private token cell where basically insiders, VCs buy it, venture capitalists, basically high net worth individuals, funds, smart money buys it. Typically, you'll have different stages of fundraising for token cells. You have a pre-seed or seed round, which is super early, where the idea hasn't even really been proven, right? And typically that's done by VCs or angels, either people who are friends with the founders, close to the founders in the same network. They'll give them, kind of like angel investors, they'll give them money to kickstart and prove out the idea. Then as there's some traction, then they'll bring in VCs who then will double down, add more money into it. And once it's proven, then maybe they'll bring in the retail investors to give them access to the token to use in the network or ecosystem. Now, how should somebody go about investing in token cells? Same thing with risk management. I would not put more than 5% of my portfolio into a token cell. If anything, I'd put 1% of my portfolio into a token cell. Because besides crypto being risky, you're investing into an asset that's not trading yet. It's illiquid. And when it does trade, you don't know what it's going to be trading at. You don't know when it's going to be unlocked. Because in crypto, it happens all the time. Projects would tell you that the token will be tradable within a week, a month, a few months, 6 months, whatever, and it gets delayed. Right? For example, Filecoin told us it would take 6 or 12, I think 1 year. It took like 2 or 3 years. Right? So basically, projects will, once they have your money, they have your money. Right? I mean, they can dictate when they make the token tradable. Sometimes exchanges will take a while to list a token or whatever. So as a result, factor in liquidity risk into token sale investing with any ICOs. When it comes to IEOs are basically token sales being done directly on an exchange, and the exchange does the due diligence process. For example, Binance, Launchpad, CoinList. So the best launchpads or IEO platforms out there in terms of making money, in my opinion, but also based on the data as well, CoinList and Binance Launchpad. KuCoin has been doing pretty well recently in the last month or so, a month or two, or quarter. But in general, if I had to pick platforms where I could invest in for IEOs or IDOs or initial DEX offerings, those are pump and dumps, essentially. Pardon my French, but basically, actually, let me finish IEOs. IEOs, I'll do Binance Launchpad, CoinList. I mean, those are the top two. They do most of the due diligence. They've done great projects like Solana was on CoinList. Let me actually get the list of CoinList IEOs. Let me see, CoinList. Okay, I don't have the list right now, but basically, CoinList has done Solana. They've done. I thought I had it somewhere. Okay, yeah, here it is. 10 best performing CoinList Launchpad. So they did Solana, which did a 775x. They did Flow, 83x. Immutable X, 28x. Near, 22x. Filecoin, 12.5x. Mina Protocol, 12.5x. And guess what? All those projects, Tokenomics covered, and we scored them highly as well. So if anything, CoinList, their research and our research matches up the best. That's why we prefer them out of any IEO platform. We think they're the creme de la creme. Then you have Binance as well. Binance had Matic Network, Polygon. They had Axie Infinity. Like those two, they get the best deal flow for the best returns. So as an investor, I think I would just focus on those two. The other platforms out there, they have what I call Ponzinomics and the pump and dumps. Because in crypto, you can have a project go up and come down real fast. But what matters more to us is finding projects that go up slowly, but keep going up. Right? It's a marathon, not a sprint. So one example, let me see if I can find this. I'm trying to find, like let's do PokerStarter, all right? PokerStarter projects. The reason why I call these Ponzinomics, right? PokerStarter is an IDO platform, initial DEX offering. Or I'm sorry, this is not really a DEX. IDOs can be on other platforms, but basically, let me pull this up here. It's meant for Polkadot ecosystem projects, but then eventually it kind of expanded to other blockchains, right? So they have Ethereum, Binance, Solana, Polkadot, Polygon, Kusama, Silo, right? But don't just look at how these projects fare. Look at how they fare on the long term. I'm trying to find if any of these projects are trading. And basically what they do is they'll give up a small allocation to projects, but they'll structure the tokenomics so that they pump early on. But I mean, we want projects that pump on the long term, right? So can I sort by date? Here, let's stick to Ethereum. Okay, let's see here. Orion. So for example, Orion Money, Lithium Finance. Yeah, I mean, so the reason why I don't like them so much, one, the allocations are very small. So these are designed for small investors who invest anywhere from $500 to sometimes even a lot less. And yes, they do pump. But in my opinion, all these projects, don't do well long term, right? Because you aren't just trying to find a project that will do well right now. You want to find a project where when the bear market comes, what products will bounce back? And 95% of these projects will not bounce back. And that's something I'm pretty confident on. Stratos, STOs, is this trading? Give me 1 second. STOs. Okay, so looking at this, STOs, 2 points. Okay, current price 217. Can we click into this? Yeah, so there is $300,000, allocation $2 to $300, price per token 30 cents, and it's now trading at $2.14, right? So that's not bad, right? But the hard thing is getting in, right? Typically, you have to go through a whitelist, you have to have the token, make sure you get in. So if you have if your portfolio is not small, it's typically not going to do too well, right? But typically these projects, these platforms are designed to help pump the bags of insiders who invest at this price. Like let's say VCs invested at 30 cents at larger allocations. Then they come into these projects and they set a price for retail investors to come in and buy and then pump on exchanges, right? Because what they work on is FOMO. They want to create as much FOMO as possible. Allocations are very small to get as many people in, to get the community to be as large as possible. But for example, one of my friends had a project called Paid Network. Yeah, it was a launchpad as well. Let me see was it Poker Starter? Okay, it was Ignition. And I think this is their own launchpad. Anybody know where Pay Network was? Token sale. Okay, going to ICO drops. Yeah, so this was earlier in the year, January 25th. There's 150K. Okay, so market cap 67. Okay, I thought Pay Network. The reason why I'm pulling this up, once you understand this, you kind of get how these projects work, right? So, yeah, it launched. Their price was 4 cents. ICO token price was 4 cents. Right now, it's at 55 cents. So yes, technically you're still up. But the reason why I don't really like these token sales or launchpads, they only make sense if you get in. But it is very hard to get in, right? So Paid Network, launchpad price, 4 cents. When it launched on exchanges, 44 cents, 44x. It went as high as $5.95, right? So that was, I think, a 100x return. Let me just do my math real quick. $5.95 minus 0.04 gives us 5.91. 5.91 divided by 0.04. So it was basically almost a 150x return on your money if you got in. But guess what? Most people don't get in. And when they don't get in, they practice poor risk management and they chase and they FOMO and they buy on exchanges and the price goes all the way up to $5 to almost $6, $5.95, with a trading volume of almost 12 million daily trading volume. And guess what? It peaks and comes down crashing. Right? So the people who bought the top, right? The people who didn't get in and bought the top, they're wrecked. So basically the lesson with token sales and these launchpads, they're good if you can get in. But if you can get in, you get out. Bada bing, bada boom. Right? These are not value investment plays. These are pump and dumps, Ponzi-nomics. Right? So I mean, yes, you can make money on them if you get in. But let's say you got in and you held all the way and holding all the way down, yes, you're still up, but you're only getting a 10x return versus 150x return, right? So basically, the way to play these launchpads is you have to be a savage. I mean, you basically, if you can get in, you get out. You basically take profit the first day, because the first day is going back to this, right? Because it was 4 cents first day, 10x. Basically, the first day I would sell at least your initial investment, right? Then sell on the way up, right? Find a formula that works for you. It could be something as simple as every 10x you sell 25%, right? But if you do that, you'll end up further ahead. But notice one thing: these projects, their tokenomics are being designed specifically to pump early on. But will they actually last through a bear market is a question you should be asking yourself. The answer is probably not, because there's no way all these projects are that good. All right? Because these launchpads are putting out projects so fast, right? If we go here, right? Almost every single day there's a project launching. All right, different chains, right? And going back to our thesis, right? 1 out of 10 projects will do well, right? So to me, this is a pure trade. View this as a trader, not a long-term investor. You only become a long-term investor after you've recouped your investment, and then some, probably a 10x or more, right? Always keep some house money, right? Always keep a moon bag, because some projects keep on mooning. But the goal of all these IDLs is to take profits as quickly as possible. Okay, so let me take some questions here. Hell says, but Ian, are there good projects where most folks can get in without investing 100K? I would say the two platforms I just mentioned, right? CoinList and Binance Launchpad, those, in my opinion, have the better percentages of finding projects that will still be around after a bear market. Right? Because as an investor, the best time to invest is in a bear market, right? That's when you find the best value. Going back to the chapter on value investing, you find that in a bear market. But, I mean, best case example is one of the projects that gave me 100x return back in 2017, Icon. Icon is what taught me this. Right? It's not just about finding a 100x return, right? Because I got into the private sale of Icon at 12 cents. So technically, right now, I'm still up, even though I got out of Icon a long time ago, right? But Icon was a pump and dump. I mean, I hate to say it, but I mean, look at the price. Textbook pump and dump, right? Put in my French. Don't kill me, Icon community. I mean, great project, but the tokenomics, the way they're designed, right? It opened up 47 cents, went all the way to what price is this? $12 something. Okay, one stop. So 12 something, right? Over $12, 100x return on your money. But guess what? I have some people who held all the way up, all the way down, and guess what? They don't have 100x anymore, right? Either their tokens were restricted because of vesting schedule or lockup or whatever, right? Because it was based on how much money you bought or whatever. But Icon is a good project. I mean, not the best, but a good project. But guess what? As the market matures, right? It came out at the peak, basically December into January was when it peaked at the top of the last bull run. Then bear market came, good projects get wrecked. In a bear market, Bitcoin dropped like 85%, Ethereum over 90%. So the projects that weren't those two, 95% or more on average. And basically a good project will drop 90% or more in a bear market. A bad project goes to zero. I mean, basically zero, no liquidity, wrecked, right? But even the good projects don't do so well. But what really hit home with Icon, we're now in a new bull market cycle. And guess what? ICANN has never bounced back. ICANN, even as we're taking NFT to the moon, metaverses, DAOs, all this, Axie Infinity stuff, Polygon, Helium, guess what? It still has not hit its last all-time high from its last bull market, over $12, which means the market has moved on. I mean, all-time high is down 88% from its all-time high of $13 in a bull market, in a new bull market, meaning that investors do not care. In the last 1 year, it's only made a 3x. So now, as a value investor, we're not just trying to find the next icon, right? Because what I'm saying is these projects on these token cells, these IDLs or launchpads, they're just icon 2.0. I mean, not to be harsh, but the question isn't, so basically if they're icon 2.0s, you have to get out while the getting is good. Otherwise, when the bear market hits, this will happen and it will never go back to its all-time high. So now, as a value investor, we have to think about the long term. We're not just finding projects to invest in that will give us a quick flip. If that's what you want, that's fine. You're a trader, take the money while the getting is good. But the best returns I've found are finding projects that when this bear market happens, they bounce back and bounce back even higher, right? So back to Polygon. I mean, this is textbook. If we go to, because Polygon came out, look, it came back 2019. You could have got Polygon for under a penny. It went flat for a while. You had basically over a year to buy Polygon under a penny. And it went up, came down, bounced back even higher. So the key to making money in crypto is being able to find projects that will bounce back. Because it doesn't matter what project you buy, they all will get wrecked in a bear market, right? Because if we go to Bitcoin, hopefully this hits home, right? If we go to Bitcoin and we go to, let's say 2017, yeah, so basically from 2017, actually no, this should be, let me do November. All right, so basically Bitcoin went to 19K, crashed all the way down to under 4K, right? Went flat, but bounced back. So Bitcoin bounced back, right? So the good projects, the great projects will bounce back. So your job as a long-term value investor is to find what projects will bounce back. Because every project, even the best ones, crash. As I said, Bitcoin crashed 85%, and right from 20K to 4K, basically, right, over 80%, and that's the number one project in market cap. Same thing with Ethereum, right? If we go to ETH, same exact thing. If we do 2017, right? Ethereum went to 1,400. Went down to as low as $100. Yeah, almost $100, right? Lost over 90% of its value. Bounced back. Now we're pushing. Now it went over almost 5,000 Ethereum, right? Good projects bounce back, right? So these launch pads, I don't believe in them because they're pump and dumps, which is fine. Make the money. But all these projects will not be bouncing back when the bear market hits, right? So you find projects that will bounce back based on fundamentals and technology and community and adoption, right? Not based on projects that structure the tokenomics to pump. And that's really my take on token cells, right? Let's go to security tokens. Security tokens, this is basically taking securities, stocks, real estate, and tokenizing them on the blockchain. So you have STO, security token offerings, similar to ICOs or IDOs on token sales, except all this has to be regulated on different platforms. There's a blockchain project we covered with the customers called, it was Polymath, now it's not Polymesh. They did rebrand themselves recently. This one is worth looking into. Was it Polymesh? Why isn't it here? Okay, looks like CoinGecko still has the old name. Like I was saying, okay, yeah, so the Polymesh Blockchain Initiative. Yeah, so in terms of security tokens, this is worth looking into if you like security tokens. Then you also have Algorand. Algorand is being backed by Wall Street. Anthony Scaramucci and Wall Street were pumping this to their investor base at a SALT conference. But basically this is a pretty decent technology. But why Wall Street likes it is it's great for compliance. It has built-in compliance capabilities. And even the SEC at one point issued a positive sentiment and quote on Algorand due to the whole compliance. Let's see if I can find what it says here. Compliance. Yeah, efficiency of administration such as compliance and reporting, role-based asset control. But anyway, I mean, security tokens honestly aren't that fun. I mean, in crypto, it's basically just tokenizing, but it's taking legacy markets and tokenizing them on the blockchain, right? And if that's going to happen, it's going to happen on Ethereum or on Algorand, in my opinion, or on Polymesh, right? Those are the movers out there. And you have to have regulated exchanges out there to trade security tokens. And there aren't really that many that are licensed, because you have to be licensed as a ATS, which is alternative trading system for crypto. And there have been some in the past, but nobody has really used them. Right? There's Securitize, which is a company that lets you securitize and tokenize securities. This is one that's covered in the book. But honestly, I mean, to me, they're just not that fun. Right? And we've been going for a while, so if you like the STLs, you can look into that on your own time. Let's move on to the next topic, DeFi, decentralized finance, which is one of the most fun topics in all of crypto. DeFi summer. All right, so if you enjoyed this live stream, be sure to smash the like button, subscribe, put on alerts, tell a friend to tell a friend, not being in crypto, or being with token metrics is a financial crime. All right, so now we're going to do chapter 12 of the book. What is DeFi? So DeFi, this might take a while, because we have DeFi, then we have DeFi 2.0. Crypto moves so fast, things change so much. All right, so DeFi 1.0. DeFi stands for decentralized finance, taking services that are done by banks and bring them on the blockchain and having them have no central intermediary. So examples include saving, investing, interests, loans, basically anything the bank does, taking those services, removing the bank, and still having trust. That is DeFi at a high level, right? And this is so powerful because now people that were locked out of finance cannot participate without any gatekeepers. What do I mean by that? All right, so for example, one of the platforms I like and I've used, although the token hasn't done so well due to Ponzinomics, or well, not Ponzinomics, just poor tokenomics, is Liquidity. So let me pull this up. Where the heck is their site? I'll just look it up on CoinGecko here. Right, because once you get this, you'll get the power of DeFi. Right? What if I told you you could borrow against your crypto and leverage your crypto as collateral to borrow against it? That's an example of a DeFi use case and why DeFi is taking over. And you could do it without asking for permission or doing a loan application. Right? So in this instance, this is liquidity, right? Interest-free liquidity at your fingertips. You can borrow LUSD against Ethereum at 0% interest rate. And they have over $2.4 billion locked up. Right, so let me log in here. Just give me 1 second. I'm gonna log in using my MetaMask. Okay, so earlier we touched on MetaMask and using DeFi. So this is an example. So right now I'm logging into my MetaMask, which is connected to my ledger, but I'm not going to use my ledger right now. Okay, so by doing this, I'm now accessing Web3, Web 3.0, the next internet, right? And this is why it's powerful. The next internet, I own everything that I have, basically. Okay, so in this case, the way this works is, I have Ethereum. I believe Ethereum will flip Bitcoin, and I don't want to sell my Ethereum because I'm losing out on future money, future profits, future gains. But I can borrow against my Ethereum to get liquidity to maybe buy a car, buy a house, pay off bills, loans, what have you, while still having the upside for Ethereum. And guess what? The whole transaction is tax-free because the loans are not taxed, but if you sell, you have to pay capital gains taxes. Because technically I'm not selling, but not tax advice. Talk to a CPA for that. So with this, so in this example, looks like the UI has changed since I last logged in. I can say that I want to borrow. So typically with a bank, you'd have to go to a bank, put in a loan application. Actually, no, prior to that, you have to be a customer with the bank, typically. You have to open up an account with them. It takes some time, credit check, background check, all that, KYC, AML. Then you basically put an application to borrow money from them. They take their sweet time. So that entire process takes a while. And you have so many people who are locked out of that. Maybe they don't have bank accounts or whatever, right? Okay, can't pass their checks. But with this, with DeFi, you can come here and you can borrow against your money. So in this case, I have Ethereum and I'm going to borrow against it. Just give me 1 second. Let me just see how this is. Okay, so in this case, I have deposited, this is a loan I did a while back. I deposited 18 Ethereum, which is worth $72,000. And they use a stablecoin, right? A stablecoin basically is a cryptocurrency, a token that is pegged at a stable price, or a stable price range. There's typically a slight deviation, but in this case, most stablecoins are pegged to the US dollar, to the price of a dollar, meaning that one stablecoin, in this case, one LUSD, is worth $1 or close to $1. Sometimes it's 99 cents based on fees and transactions, but the most popular stablecoins are Tether, DAI, LUSD is getting pretty popular. But in this case, I deposit my Ethereum into a smart contract. They get the value of this $72,000, and this is all fully automated. And then they let me borrow a ratio of that. Right? So in this case, I put $72,000 worth of Ethereum, 18 ETH, and I borrowed $22,000 in LUSD, stablecoin. Just like that. No waiting in line, no opening an account. All this was fully automated with software, with code, with a smart contract, right? And the reason why this is powerful is there's no interest rate as well on this. So people are wondering, how do they do this? How do they manage this, right? They do this using essentially math and collateral, right? So in this case, you have what's called my collateral ratio. Sorry, this is the ratio for the whole network. So for every dollar borrowed, they have 226% collateral to cover that. Yeah, and in my case, I borrowed $22,000 and they have $72,000. So they have 225% ratio. So that if the price of Ethereum fluctuates, as long as I still have enough money to cover my debt, I am good. Right? Now, what happens if the price of Ethereum crashes? Because it happens in crypto, right? Let's say ETH tanks 40% due to a black swan event, like with the pandemic. So let's say ETH goes to two grand. Let me actually go over here. If we go to liquidation, right? So the way Liquidity works as a platform is they go through and you have to maintain a ratio of 110% or more, right? So if you borrow $100,000 worth of stablecoins with ETH as collateral, with Ethereum as collateral, you have to put $110,000 minimum. If your ratio drops below 110%, it gets liquidated. Basically, your collateral is sold to cover your debt. So you have to basically manage this game of making sure your collateral is worth more than the collateral ratio of 110%. Now, it may get somewhat technical, but it's still pretty simple at a high level, right? You have to maintain above the collateral ratio. Now, let's say the whole network as a whole goes through this essential digital bank run, right? Where everybody's trying to withdraw money because of the crash. There's a fight to liquidity. What do you do, right? So, I'm not sure if they covered this here. Okay, that's not what I wanted. But when that happens, they shift the ratio to 150%. And when that happens, basically when there's a bank run, based on a market crash, everybody has to maintain 150% or more. And those who have lower than that get liquidated by other people. I can log in here, I can liquidate that, and in exchange for that, for taking initiative to liquidate somebody, it's kind of cutthroat in that manner, I get a chance to purchase, I believe, Ethereum at a discount. So basically, it's a convenience fee, right? Now, this all seems fine and dandy, but without getting too deep into this, I want you to understand the power of this, right? Because my ratio, I'm pretty good, right? I'm not gonna get liquidated anytime soon, but I was able to borrow money on Ethereum. On this platform. What do I do with that money? I take that stable coin, I then take it to an exchange, which is also part of DeFi, like One-Inch Exchange. Because my goal is, how do I convert LUSD stablecoin to actual cash in my bank account? How do I do that? All right, so the exchanges that I use are Gemini and Coinbase Pro. Not Coinbase. Coinbase Pro is better because they charge you lower fees. Coinbase regular is good in the sense that it has a better UI, UX. It's basically a better experience for users. It's newbie friendly, a lot easier to use and simple to use. But in exchange for that newbie fee, for being a newbie, they charge you a lot more in fees. So you can use Coinbase, but most pros use Coinbase Pro because they're lower fees. But anyway, how do I actually cash out? So I would go to a platform like this, like CoinGecko, and say, okay, where can I cash out LUSD, which is the stablecoin they gave me on Liquidity, right? Then I come down here to markets. You can also do this on token metrics, right? So I'm looking for a fiat gateway. What does that mean? Fiat gateways are where you can connect your bank account and wire dollars or whatever currency you have in your region, the euro, the yen, and you use that to cash out, right? So fiat gateways are the gateway where you bring your dollars, you buy crypto, and you convert vice versa. So in this case, I want to take crypto, convert it to dollars, and cash out to my bank account. It could be Bank of America, Chase, whatever bank account you have. So in this instance, all these are different markets where we can trade, but I want a fiat gateway. I want the US dollar. So guess what? There aren't really any fiat gateways for this. So this becomes a challenge now, right? Where do I go? There's no gateway. I mean, there's no Coinbase, there's no Binance or whatever. So what you can do is you can swap LUSD to a different asset and use that to cash out, right? So in my case, I like Coinbase Pro for depositing dollars to buy crypto. But cashing out, I prefer Gemini because Gemini has no withdrawal limits. With Gemini, if you have a large portfolio amount, you can withdraw $500,000 or more just like that in one day without any questions asked. On Coinbase Pro, you typically have to go through and request permission to increase your withdrawal limit. So I don't like having to ask for permission to withdraw my money. So I come here to Gemini. Actually, sorry, not Gemini Dollar. Gemini the exchange. Then I look at the markets they have, right? So what stablecoin do they have? The stablecoin they have is DAI USD. As you see here, $1 gives you 1.999 DAI. So how do I convert DAI? How do I convert LUSD to DAI? You do that through a decentralized exchange. You can do it through Uniswap, you can do it through One-Inch Exchange, or you can do it through Curve, right? So Uniswap is the most popular one, and so is SushiSwap as well. But I like One-Inch Exchange because it's called a DEX aggregator. It takes all the different DEXs out there and finds the best prices for you automatically, so you don't have to, right? So in this case, let's say I wanted to convert the LUSD I borrowed, right, to DAI. I don't have any now, but in this example, let's say I had, $72,000 worth. Where would I get the best slippage, right? So in this case, One-Inch would give me the most money. Slippage would be minus 0.19% versus Uniswap, which is minus 0.26%. Right? Now, a better exchange for converting just stablecoins, because One-Inch Exchange is good for any crypto asset on the Ethereum blockchain. And its assets on the Ethereum blockchain are called ERC20 tokens. So, one that's best for stablecoins is called Curve. Because it's designed with what's called a bonding curve, because all these are automated, right? It's what's called an automated market maker. It's basically an exchange where you're trading against two different pools of liquidity, right? Two different trading pairs. In this case, we have DAI and we have USDC. Now this gets somewhat technical. I don't want to get too technical because it's meant to be a high-level overview or masterclass on crypto investing. But when you have two different trading pools, basically using math, using an algorithm, they balance each other out, and they use that to find the best price to fill. It's called a bonding curve. So if you just search crypto bonding curve, let's find the actual image here. This is how the price is balanced, right? So basically you have the pool balance and the token supply, and using algorithms, it's basically calculating what price based on how many tokens you have, right? So let's say you add $100,000 worth of Ethereum. I'm sorry, yeah, $100,000 worth of Ethereum and $100,000 worth of DAI in the pool. It's basically trading against each other to create an automated exchange. And as people go through and buy and sell, there'll be an imbalance. That imbalance creates basically the bonding curve. But anyway, for stablecoins, because most assets are pegged to the similar price, $1, having a bonding curve for non-stablecoins is not ideal. It's better to have one just for stablecoins, which gets you a better price, right? So in this case, we want LUSD. Right, so we take that LUSD there. And if we're going to Coinbase, we can use USDC, which is the Coinbase stablecoin. It's regulated. But I want DAI because I'm going to Gemini. And I'll put in the same price. I'll put in $72,000. So on Curve, $72,000 worth of LUSD gets me $71,937.23. If we come to One-Inch, right, 937.23. Yes, so if anything, I think 1 inch here is actually going through curve. So that's why, I mean, if you're doing stablecoins, it's best to use this, but just doing purely on 1 inch, they typically can find the best platforms for you, right? So you basically convert by selling your token from LUSD to DAI, then you transfer that using your wallet to your exchange, Gemini, and you cash out, right? So that's one way to borrow in DeFi without any middleman, no bank, anybody asking for permission or gatekeeping, right? Then the other element of DeFi that really helped DeFi just grow is yield farming. What is yield farming? Think of having a bank account where you're earning an interest rate on having money in your bank account, right? Your savings account. Except you're not really earning much to keep up with inflation, because inflation was pretty high, and so is the decline in purchasing power. But when it comes to crypto assets and DeFi, these are networks, right? These are protocols that are taking services done by banks and they're trying to disrupt them. But they need liquidity. How do you bootstrap liquidity? How do you incentivize people to add liquidity on these protocols? Because, for example, with a DEX, a decentralized exchange, like Uniswap, One Exchange, and others, you have to have trading pairs to trade against. And there has to be liquidity for you to trade against that's automated. And that needs people's money in there. And people won't just give you money just to trade for no reason unless there's any upside for them. Right? So you have to give them a reason to put the capital up into that liquidity pool, also called an LP pool, right? Basically, these people are called liquidity providers. And by adding this liquidity, they expect to earn some kind of incentive, some kind of reward, some kind of interest on this. And this is where the term yield farming comes, right? Yield farming basically means that you're adding your liquidity to a liquidity pool, and in exchange for that, you're earning a yield on that. You're yield farming. Right? And the incentives on this can be pretty high, right? So if we go to, for example, Curve, right? These are the Curve pools, right? For anybody who adds liquidity here, actually Curve is probably not the best to use. Curve liquidity pools are pretty low. But let's go to Zapper. If we go to pools here, we can see the, okay, this is not what I wanted. Let me just see which, actually CoinGecko has this as well. All right, so if we go to DeFi, looks like they moved this around. Okay, give me something. Okay, yes. So actually, CoinMarketCap has the rates on this. So for instance, if we go to highest APYs, right. So in this case, PancakeSwap, which is a DEX on the Binance Smart Chain. Basically, this is Binance's blockchain, and their DEX is called PancakeSwap. Their decentralized exchange is called PancakeSwap. But the liquidity is very low, right? Liquidity is only under $4,000, right? And the APY here is high, but it's not ideal, right? Ideally, you want to put assets to work into a liquidity pool that's liquid. Otherwise, you face liquidity risk and then impermanent loss, which is not good. All right, so, for instance, sorry, my iPad's about to die. Okay, there we go. Okay, so let me see which one I am doing. Yeah, I'll actually use Armor Finance as an example, even though I'm not using this anymore. But if you go here to liquidity rewards, right? Basically, if you have Armor and Ethereum, and you add it to the Uniswap liquidity pool, this is their pool contract address, right? So basically, the way this works is you take your Armor tokens that you already have and your Ethereum that you already have, and you stake it in a Uniswap liquidity pool, right? So you come here, I have to connect my wallet. Let me connect MetaMask. Okay, so here I've connected this to MetaMask. Okay, so you come here, you go to add liquidity. Once you do that, right? I don't have any tokens, but you would come here, and by doing this, by adding my Armor tokens and my ETH tokens, I pick the share, but they have to be an equal balance. So let's say I added 10 ETH, then I have to add 10 ETH worth of Armor. Actually, let's do it with 1 ETH. And out of the entire pool, my total USD value combined would equal 0.57% of the pool, right? Then they gave me a new token called an LP token, liquidity pool token, right? That represents my ownership share in this liquidity pool. Then basically my assets are locked in this pool. And then I take those tokens that represent my ownership share, I come back here, I then stake them to lock them up as well so they can be moved. And by doing that, I have locked up my liquidity and my ownership share in that. And now I'm earning yield on this. So this yield will be 103% APY. So basically, in 1 year, if I have $10,000 worth of Armor and ETH, I'll be earning another $10,000 plus in Armor tokens. Right? This is where it kind of becomes risky, right? Because if you're bullish on the asset you're yield farming, that's great. If you aren't bullish on it, if Armor tanks like it did, then guess what? Your tokens become worthless, right? That's what's being worth $10,000. It could be worth $2,000 or nothing, right? So it's a gamble, right? Okay, so yeah, this project is kind of pretty much dead, but it's a good example of explaining yield farming, right? Then there are platforms out there that automate yield farming for you, right? Like there's Harvest Finance, for example. Right, so Harvest Finance takes that concept of yield farming and automates this across different pools. So it's almost like a robo-advisor for yield farming. And this has been hacked several times, so which happens in crypto and DeFi. So before you engage in anything, make sure that it's been audited. This is something I didn't cover too much in the technology part. But any project in DeFi, you want to make sure there's been a code audit by a reputable company that's public, that goes through and sees if there are any possible hacks or issues that can be hacked. Right, so in this case, Harvest Finance, which we've covered, it's scored over an 80%. You can come here and it can basically manage your pools for you. You can pick what pools to invest in, right? But this is kind of getting advanced. I want to keep this high level. But this is basically automated yield farming across different tokens and protocols. And looks like they just added one for Polygon, which is pretty cool. Right, but that's essentially is yield farming at a high level. Let me see what else I want to cover for DeFi. We covered DeFi lending and borrowing, yield aggregators, derivatives. Yeah, I think that's basically it. That's DeFi without getting too deep. Now let's go to the next section. We kind of piggyback off of DeFi. Introduction to mining and staking. So what is mining and staking? Mining, like Bitcoin mining, is the process of creating a new coin through calculating a very complex mathematical problem using your computer, right? The different forms to mine, there's mining such as proof of work, which is Bitcoin mining. You have staking, which is done typically by proof of stake, where it's not done by mining like with Bitcoin, where you use power. You basically use, similar to percentage ownership in stocks or equity, you basically use a consensus mechanism where people can vote and basically confirm the blockchain using a consensus of their stake in the network. So for example, Helium Network has a hardware miner, which I have over here somewhere. Actually, I'll just Google it, right? So you have Helium Network miner, right? So these are examples of miners. You plug them in and you basically, with Helium, you connect the miner to your, kind of like this. You connect the miner to your Wi-Fi via Bluetooth, and it shares your Wi-Fi connection. In exchange for that, you're mining Helium tokens by sharing your Wi-Fi. You're basically earning new tokens that have never been seen before. So that's basically mining at a high level. Then staking is similar, except it's done through software. There's no like physical or power. It's all done through software. Like Ethereum is going to shift to proof of stake with ETH 2.0. And staking is a great way to earn extra yield on your tokens, right? So for example, Matic. Ideally, anything you're holding in your portfolio for the long term, you want to earn extra yield on it. So if you have anything, go through your portfolio, whatever you have. If there's staking available, stake it to earn extra yield. If there's if there's yield farming available, yield from it as well to earn extra yield. So a good platform is Staking Rewards. If you go here, stakingrewards.com, this shows you the different rewards you can earn for staking different crypto assets, right? So this shows you the top 10 crypto assets by staked value. So right now, wow, surprisingly, it's Solana. Okay, I didn't know this was the case. So Solana has $77 billion staked, and the reward rate, or the APY, is 6%, 6.05%. And 76% of all the tokens circulating for Solana are staked. Then we can go through all this. So let's look at what has the highest reward rate right now. Okay, Olympus DAO. Okay, so this is actually a good segue into DeFi 2.0, but let me first finish up staking. So you have Olympus DAO, which has 5,900%, almost 6,000%, which is crazy. You have Swift Chain, which is a DEX on Cosmos. We covered. It scored over 80% on code review. This is actually on my watch list. Didn't know it was this high. Very interesting. Axie Infinity. Right, then if we go to actual staked value, which was what we were looking at before, Solana, Cardano, Ethereum, Terra Luna, Avalanche, which actually reminds me, I have to stake my Avalanche. But if we go to actual highest percentage of tokens staked, not sure. Okay, so these numbers seem kind of wacko. We have Mina at 98%. That's very interesting. But okay, so what is staking, right? Staking is similar to what we did with Armor. So in this case, if we go to, for example, I'm staking Matic network staking. I'll just Google this. Always go through official platforms for staking. So for this, we'll go Polygon website. So let me connect my wallet. Okay, so basically staking is you take, okay, looks like I have to sign something. Okay, I cannot do that then. Okay, I wanted to demo that, but I cannot. Okay, but basically staking, I'll just explain the concept. Similar to what I did with yield farming, I take my tokens, I lock them up for a period of time. In exchange for that, I earn yield. It's that simple, right? Kind of like a savings account at a bank account, right? You basically go to your savings account at your bank, lock up your money, they give you a yield, right? That's all staking is. Now, let's go to DeFi 2.0 and why it's so disruptive, right? So DeFi 2.0. So we talked about liquidity pools and why they're of value, because basically any project that wants to bootstrap liquidity on a DEX, like Uniswap, Exchange, and others, they have to give incentives to the community to add liquidity to the liquidity pool, right? To add the trading pairs, because you always have a pair, right? You have the token and the token that's being traded against. It can be ETH, right? So in this case, we have liquidity and ETH, or we had DAI and ETH. But let's say that the issue with all that is there's a finite amount of tokens they can use as an incentive for rewards, right? These are called liquidity incentives or liquidity rewards, right? Eventually that APY will dry up because that APY is coming from the treasury of that project, right? Because any project will have tokens. So let's say we have 100 million tokens and we allocate 50% of them just for liquidity rewards, or incentives to give to LP pools, right? To give to liquidity providers. But eventually those tokens will run dry. And guess what happens? As that APY decreases, liquidity gets pulled out of that LP pool and a rug pull happens. Eventually there'll be no liquidity because nobody's getting rewarded for adding liquidity. So why lock up your capital, right? Because it makes no sense. It's not rational to do as an investor. So when that happens, projects have no liquidity and they're back to square one. So with DeFi 2.0, it's disrupting. Now, actually, this section was not in the book because this is totally brand new. Crypto is so innovative, so it's happening so fast. So DeFi 2.0 flips the whole concept upside down. Why outsource liquidity to the community? The protocol, the project, the cryptocurrency should own its own liquidity. But how do you do that? So it borrows from legacy markets with bonds by creating this new concept called DeFi 2.0, protocol owned liquidity. And Olympus DAO, which I do have as a token, and I'm bullish on, I've been staking this for the last month, maybe month and a half or so. And as you see here, the APY is pretty high. And they have over $2.4 billion total value locked with 710 million in the treasury. You're probably wondering, how do they support all this high APY? It's all based on game theory and incentives, right? The game theory and incentives have been shifted to add to have people come and want to actually add liquidity, right? So we take the same concept as before, right? Basically what happens is you go to the website, you basically, let me actually log in here. Give me 1 second. Let me find a wallet that has some OM in it. All right, so basically you come here. Okay, looks like I have to migrate to V2. That's been enough. Okay, all right, so I guess I can't really demo this without doing what I wanted to do. Okay, so basically, I'll just explain this at a high level then. So basically, you're adding liquidity as you do with Uniswap, right? As we mentioned here, right? You come here, you add liquidity, except as opposed to staking the token, right? That LP token you have, basically, that token, your liquidity token, is now being resold back to the project. Right? Why do that? Because the project is basically going to give you the incentive to do that. Right? When you come here, they're basically issuing bonds that you can purchase at a discount. Let me just make sure I have this right, because it is somewhat confusing. Right? So let me just go through this diagram, right? How Olympus works, right? It's basically bonding. It's introducing bonds, crypto bonds. Once you get that, if you get bonds from legacy markets, we're bringing bonds to crypto. And the same way the government issues bonds to help finance activity, or how corporate bonds work, how a company can issue bonds at a discount to help finance activity, we're now doing the same thing with crypto and DeFi, being done by the project. The project is issuing bonds for LPs, and it owns that liquidity, right? So basically, bond sales and LP fees increase treasury revenue by adding liquidity, right? And then they mint a token, right? Token yields automatically through treasury, blah, blah, blah. I'll just keep it light. Basically, the project issues a bond, right? And you have the incentive of that bond is backed by actual treasury reserves, right? So this treasury balance backs the bond, if I'm explaining this correctly. Somebody please correct me if I'm wrong here. So for example here, this is the market price for Frax, right? Frax is a partner with Olympus DAO, right? So this is the market price. but you can get this at this bond price at this discount, right? And they give you an ROI for that if you lock it up for 5 days in this example, right? But that's really DeFi 2.0. DeFi 2.0 is essentially crypto bonds. The reason why this is powerful for any crypto investor as we head into 2022 is for the first time we have a new asset class in crypto that has a high yield with low risk, to a point where this made me completely disrupt my entire portfolio and say, why am I holding these altcoins in a bull market that are underperforming when I can have a crypto bond that has a lot lower risk and high yield? Right? Because we're so early right now that there's a glitch in the matrix, that in typical legacy markets, bonds are very low return investment. They're better than savings accounts, but because crypto is so brand new, so disruptive, and for a limited period of time, we have high yield bonds, and high yield in crypto is 6,000%, sometimes even more, right? So if we go to platforms like Time Wonderland, which has even higher APYs, right? Time Wonderland is a fork of Olympus DAO put on the Avalanche blockchain. Avalanche is a blockchain similar to Ethereum, but different. It's basically an internet of blockchains, kind of. It supports Ethereum blockchain and other blockchains. So in this case, you can, I have to switch my MetaMask to Avalanche. So MetaMask does support several blockchains like Avalanche, Polygon, Binance Smart Chain. So in this case, I have switched to Avalanche. Okay, all right. So in this case, we have the same exact concept, right? It's a fork. They took the same code because Avalanche supports EVM, Ethereum Virtual Machine. So all the Ethereum applications can be ported over and run on Avalanche, which is pretty cool, which is why I'm very bullish on it. Not financial advice. Okay, this is the dashboard. Their APY is 70,000%. That is insane. Right, basically, $1,000 turns to 70,000. I don't know, sorry, to 700 grand in 1 year. I mean, that also depends on the price. If the price stays stable, right? But still, I mean, right now, biggest wealth transfer in human history is happening right before our eyes, right? So what I'm doing is I'm staking on both Olympus DAO and Time Wonderland, and I just sell my yield every month. Right? I sold some yield recently, about 1 or 2 weeks back, prior to the holidays. But they have $2.7 billion market cap. They have 1.8 billion in TVL, in total value, locked into their protocol. And this is the treasury they have that's backing the assets. It's never going to be one-to-one, but this shows you the runway, meaning that how many days would it take for this to collapse, basically, right? So the runway is 407 days before this would collapse, right? So if you're concerned about this being a Ponzi scheme or whatever, I mean, there is treasury backing this. If you understand how bonds work in legacy markets for corporate bonds and government bonds and municipal bonds, we're doing the same thing in crypto, except the bonds are being done with liquidity and the protocol owns the liquidity. And this is very disruptive because now you have trading volume for these projects that is owned by the protocol and is not gonna get rug pulled, right? So if we go to, for example, OHM, right? OHM is basically a reserve currency, and the trading volume has been pretty high, 63 million daily trading volume. Let me look at this real quick. Okay, this is looking just to switch this up for some reason. Okay, so it's saying to look at staked OHM. Okay, that is not what I wanted. But anyway, I mean, that's DeFi 2.0 in essence, right? And that concludes mining and staking. Okay, now let's go to the last chapter in the book, NFTs, non-fungible tokens. Now, this is going to be a very interesting section because this section is the section that has brought in lots of people who are not in crypto before, right? Non-fungible tokens, NFTs. What are they? how can you understand them? So what helped me understand NFTs and the value in them, because before I wasn't really quite a believer in them until this year, but what helped me understand them is if you understand fashion, if you understand art and how it can have value, you will get NFTs. Right? So let's first begin with fashion. Right? Why is fashion fashionable? Right? Because it's unique. Right? So for example, why are Michael Jordan shoes worth a lot of money? Right? Because I mean, they cost the same as other shoes. One, it's the branding, it's the pedigree of Michael Jordan, it's a status symbol. Right? People want to be like Mike, but also it's scarce. Right? Or like take designer brands. Like why are brands like Gucci, Louis Vuitton, and others worth a lot more? So for example, like why is a Louis Vuitton bag, whatever, 5 or 10 times more than a regular bag? Yes, there's a brand appeal to it as well, but there are other factors. Right, so other factors include things such as, let me see how to best explain this. I would say that it's the scarcity, right? So for example, best case an example is a Rolls Royce, right? A car I bought thanks to Helium and Matic, right? Why is a Rolls Royce worth a lot of money versus a Toyota? One is the quality, right? The quality of time invested in the materials and parts, right? First of all, better parts, superior parts, but also the quality, right? It takes 6 months to build a Rolls Royce and 13 hours to build a Toyota, right? But as a result of that, Rolls Royce is very scarce. There are very few, every Rolls Royce is custom made. All right, you can go and get a Toyota on a lot just like that. A Rolls Royce, you can't buy new on the lot. It has to be custom made. The ones on the lot that you buy that are used, they're also custom made, right? It's the effort and the scarcity of that car that makes its value go up, right? If you understand, for example, baseball cards or trading cards, right? Like, or even like Pokemon cards, right? For those who played Pokemon, why was a Charizard worth so much, right? Because it was rare, right? And you have to get it and evolve it into all these other different Charizard names, right? And that rarity gives it value, right? If you had like a Babe Ruth baseball card that was signed by Babe Ruth, that's scarce, right? Or if you had a Michael Jordan, if you take a rookie trading card for Michael Jordan, let's say there are 100,000 made globally, and you had one of 100,000. Yeah, not worth much. But let's say you had that rookie card signed by Michael Jordan with his autograph. Let's say you went to a basketball game with the Bulls, and he signed it for you. And it can be verified that that is his authentic signature. That basketball card is not just one of 100,000 anymore. It's now one of how many are actually signed. Let's say he only signed like 10 basketball cards his rookie year or in his lifetime. So now it's one of 10. So now 10 out of 10,000, 10 out of 100,000, I mean, that is a very rare basketball card now, right? And putting that in percentage terms, that is 1 out of 10,000, whatever percentage that is. So 0.01%, right? So that is a very rare basketball card, right? That's what NFTs are, right? Now take the same thing with art, right? Why is the Mona Lisa the Mona Lisa? Because the Mona Lisa was a very transforming art piece and alt culture. I'll say in culture and history in general, right? In the way that it was made, it was very innovative. It was first of a category in terms of how it was made, how it was painted, even though I'm not an art expert. But then the whole world has kind of agreed upon, conceptually, right, that this is something unique, that has value, that's transformational. And we know there's only one of one, and it's in this museum, right? So with it being in this museum in Europe, wherever, right? Yes, I can go and take a picture of a Mona Lisa and frame it, or I can go and print out a Mona Lisa on my photo printer and hang it in my building, in my condo. But the whole world knows I don't have the Mona Lisa, right? Because we know for a fact it is in this place, being held by this person. Because when you buy art, right? I got into art collecting this year. When you buy art, they give you a certificate of authenticity that certifies that this is a real art piece. You bought it at this place, at this gallery, at this price, at this date, and anybody can call and verify that you bought it there. That's the same thing with the blockchain. So NFTs, non-fungible tokens, are really just it's digital scarcity. It's taking things of value, of culture, from baseball cards, anything that we want to make scarce in the real world. Because as the whole world goes digital, how do we create digital scarcity? That's what NFTs do. They help us create digital scarcity that's provable and verifiable on the blockchain. That's what NFTs do at a high level, right? So we can do the same thing with art. We can now so now let's open up into a platform that's the most popular platform for NFTs, OpenSea. So I will pull up my account and I will show you basically my NFT collection. Looks like I gotta connect my MetaMask again. Give me some time here. All right, why is this not? All right, give me 1 second here, guys. Okay, looks like I'm having some issues opening this up here. All right, so for example, this is my Bored Ape, right? Bored Ape Yacht Clubs. So if anybody wants to buy this, I'm selling this for 310 Ether. Now, I did buy this for 62 ETH 4 months ago or so. Actually, I did get an offer to sell it for, what's the offer I got? Which I rejected. I did think deeply about it, but I filter by. But anyway, I'll cover that at a different time. But anyway, so why is this of value, right? Because if we go to the Bored Ape Yacht Club collection, right, similar to art. So take the concept of art in the real world, right, Mona Lisa, whatever, and now make it digital, right? So now we have an artist or art collection called the Bored Ape Yacht Club, and there are 10,000 items of these bored apes, and each of them is unique, right? Each of them is computer generated. This is called generative art, right? But with each that is unique, right? Because you have different traits, different combinations, different mixes, but they all have the same theme, kind of like trading cards. But similar to trading cards, you have some trading cards that are more rare, right? If you take, like, for example, like cards for poker, right? Like it's a lot rare to get a royal flush, for example, right? So think of that, but with traits, right? So you have 10,000 items owned by 6,000 owners. And if we take, for example, if we go down on the left-hand side, these are the unique traits, right? So you have the background colors, you can have different variations, and over here shows you how many number out of 10,000 they are, right? So the most rare color is gray. There are 1,170 gray backgrounds, right? Then if we go to clothes, it gets even more rare, right? the most rare clothing item is a black suit. There are only 42 out of 10,000 that have a black suit, right? If we go to earrings, same thing, right? So as you can see, we have different combinations and mixes, and with each mix, it gets you create a very unique Bored Ape. Now, so when it comes to eyes, only 49 have the blue beams, right? These are the laser eyes, right? Oh, I'm sorry, you have laser eyes and you have the blue beams, right? So you're basically creating a trading card, right? At least for these Bored Ape NFTs, right? Then you have the fur, right? So skipping all that and going back to my Bored Ape, right? If you go down here to properties, it shows you the rarity of each trait you have for your Bored Ape, right? So my Bored Ape has the following properties. The background color is yellow. Only 13% have this trait. The lab coat, only 1% of Bored Apes out of 10,000 have this trait. And only 1% have the earring. And 1% have the bored, unshaven look, right? So all this creates this very unique Bored Ape, right? That could have value, or does have value, right? Similar to art and fashion, it is subjective. There is a market to it, but the reason why this is of value now is all this is being stored on the blockchain, right? So yes, somebody can just copy and paste this and print it out and say they own this Bored Ape, but not really, right? Because we can physically go to this collection on the blockchain and check that I actually own this. Just like I can print out the Mona Lisa and hang it here, but the whole world knows the actual certificate of authenticity is held by this museum in Europe, all right, by the actual artist, right? So it's taking that same scarcity in the real world, making it digital and provable through the blockchain. Right? Think of it as kind of having a barcode basically a barcode that only you have a serial number, right? In the sense that, have you ever signed a DocuSign document, right? Why is that used in the code of record? Because they can, when you sign it, they have your location, they have the barcode and the numbers and everything, right? It's the same thing but being put on the blockchain with art. We have digital proof of ownership and scarcity. That's what NFTs bring. So how do we invest in NFTs? Right? You basically have two categories for NFTs. You have basically, actually they have several categories, but the way I view it is this. You have blue chips and you have everything else. Blue chips I define blue chips as art pieces that are great investment pieces that will be around for the long term, right? I take blue chip comes from art, right? From investing in art and collecting art. You have blue chip pieces where these are artists that the whole world has agreed upon are great artists, right? For example, like Picasso, right? Whether you're in Europe, Asia, Africa, South America, everybody knows Picasso is Picasso. They know he's amazing, right? They know he's a legend, basically, right? So now, how do we bring this and migrate this over to crypto and the digital world? How do we have blue chip pieces? And blue chip pieces can be defined as, in my opinion, art pieces or collections that are first of a category. They're trendsetters, they're innovative. Imagine 20, 30 years down the road, we have an NFT museum, a digital museum. Which art pieces will be in that museum and why, right? If an art piece is just a copycat, it will not be in that museum. If an art piece is innovative and trend-setting, it will be in the museum, right? So for example, the first NFTs ever, right? They'll be in that museum. Bored Apes, I think, will be in that museum because they were the first real collection with a private group and community that has gone mainstream, right? Bored Apes have become part of culture. So while you have other blue chip NFTs like CryptoPunks being one of the first early NFTs, and you have Etherrocks and others, honestly, I don't think those will really stand the test of time because the amount of holders that hold them is small, while Bored Ape is building a large community. So as a result of that, I think, although they are blue chips technically, CryptoPunks and others, I think Bored Apes will flip them, which is beginning to happen as of recently. I I could be biased, maybe, I don't know. But I mean, so going back to this, actually one site I like for NFTs, I'm looking at the rarity of NFTs is rarity.tools. Right, you can come here, it shows you the different collections, right? So mutant apes, right? These were airdrops, basically drops to all the Bored Ape holders, right? Same thing with Bored Ape Kennel Club, right? So now they're creating this community, and if you see the trading volume here, right, and the value, going back to what I said earlier about scarcity, right? This platform lets you go through and basically see why things have value, right? So this is the most rare NFT. It's a mutant ape. And we can look at this, and it goes through and creates a rarity score. All right. Then we can actually put this up on OpenSea. But let me sort by. So this takes the last sell price for any NFT that had this trait, right? So looking at this, let me sort by category. Right, so basically, let's say that any Bored Ape NFT that had these traits, so in this case is no background, right? This is not the best example. Let me pick a different one. Let me pick the actual Bored Apes. As I bounce back over here. Yeah, so this is one of one. Out of all the mutant apes, only one has this mega radioactive. And that's why it's probably worth a lot of money, right? So you have 17,400 items, and only one out of this whole collection that's been covered in Rolling Stones, by celebs and all that, only one. So this is an in-demand collection, only one. It's one of one. It is unique. That gives it value, similar to, it's like owning a one-of-one baseball card or a one-of-one art piece by Picasso, right? If you get that, you'll get NFTs. So let me get a different example. Yeah, so this is a lot better, right? So this is a Bored Ape. These are the traits it has, and this shows you the floor price for any ape with that price, right? So if we sort by traits, right? Any Bored Ape, I think the highest floor price for Bored Ape that has the mouth with the bored dagger was 95 Ethereum, right? So looking at this, if we, how do I pull this up? If we go here to OpenSea and look at the actual properties, 0.49% have this, right? And if we go and look at just all these, look at the price, right? If we go to recently sold, right? So this one got sold for 84 ETH, 72 ETH, 75 ETH, 69 ETH, right? So obviously the community values having this dagger for some reason, right? Now one thing to put in mind is not everything that is rare has value, and not everything that has value is rare, right? Because there is a data science aspect to it, but there's also an aesthetic part to it, right? The community as a whole and the culture can decide on what it finds valuable, right? So for example, there are some traits, while they're rare, nobody wants to have them, right? Because it's not cool or fashionable, right? Then there's some traits that are rare and people like them, right? Like the laser eyes, because it's a crypto thing, right? So if you understand how this works, right? So you combine all these traits and their rarity and the last price they were sold at, you can see how you can find that of value. Now, the reason why I think NFTs could also be a possible bubble, but I think they'll be great for culture and for taking crypto mainstream, similar to token sales and ICOs, 95% of them will go to zero, right? So as an NFT investor, you have to really think about this. 95 out of 100 NFTs will go to zero, right? And I think that's a safe assumption to make, especially in a bear market, right? So how do you pick what to invest in, right? If you're investing just in blue chips, that is very hard because the floor prices, unless you're well with lots of money, you can't get in, right? What you can do though, you can try to find the next big NFTs to get in, right? And by minting an NFTs, similar to a token sale, you have NFT sales, but similar to that, 95% of them will go to zero, right? So if anything, risk management, diversify. If anything, I would not put more than 10% of my portfolio into NFTs. I would say non-blue chip NFTs, right? And even then, so let's say you have $10,000, how do you invest into NFTs? First of all, you can't really do that on the Ethereum blockchain because the fees are too high. You have to go to a different blockchain like Solana. And even then, there's some issues with that, right? But let's say you wanted to mint NFTs, right? You'd come here to upcoming, ready.tools. But so far, I mean, all these are going to zero in my opinion, right? But the factors you can leverage to help you filter out what has a chance of not going to zero is community, right? How big is community? How big is it? Is there Discord? So let's say you find a Discord group that's huge, right? And there's lots of community involvement. Let's say it has 50,000, 100,000 people in the community in Discord, right? And they have lots of well-known people in the NFT space following them or involved in the community or the project. So similar to fundamental analysis for crypto, we do fundamental analysis on NFTs. We want people that are well-known in the NFT space, either artists or past collectors or investors, and a large community. We're looking for large signals of confidence, right? Large votes of confidence. And then after you do all that, you come up with a list, and even then it's still a crapshoot. I mean, but so like over here, all this is going to zero in my opinion. But let's say I wanted to mint this NFT, all right? We'll then go to this website, and we'll basically connect our wallet and would mint, right? And then, I mean, a strategy I've kind of been employing is if you're going to mint these NFTs, you treat this like IDOs and launchpads. You want to flip these NFTs as quickly as possible to recoup your initial investment, right? So let's say you mint 10. Actually, let's say you mint 5 NFTs out of 10,000, right? And it cost you, the price was how much? If we go back, all right? So 0.036 ETH. So I'll just do that times 5. 0.18, so 0.18 ETH, right? Then as soon as you mint them, I would go to OpenSea and I would I would go to, OpenSea, look at the rarity of the NFTs you got. If there aren't any good, sell them at floor price. Because kind of like with VC investing where you buy 10 NFTs and you make 10 investments and you expect one to return the whole portfolio and then do a 10x after that. It's the same strategy with NFTs, right? So my strategy would be to mint 5 to 10 NFTs, expect, let's say 10, right? Mint 10 NFTs and expect that you're basically putting in 10 bets that one of them will be in the top 100 in terms of rarity. And when that happens, that's the one that's going to catch you out. And everything else that's not in the top 100, you sell at floor price or close to floor price or enough to recoup your investment. So let's get scientific with this, right? So in this example, right, we said we minted 5 NFTs for 0.036 ETH, right? So that's 0.18 ETH. But let's say out of the, I'm sorry, I keep on messing up. We minted 10 NFTs, right, for a total of 0.36 ETH. But out of those, let's say we only keep 2, right? So that means divide by 8. I'm going to sell the other 8 at a minimum of 0.045 ETH, probably even round up to 0.5 ETH to add in fees and stuff to recoup my initial investment. So basically, I minted 10 NFTs only 2 out of 10 were good or worth holding. Let's say one was out of the 10,000. Let's say one was in top 100, and the other was top 250, whatever. So the other 8, I would sell them to recoup my initial investment, and then those other 2, I would basically hold or sell at a higher price. Maybe second one I'd sell for 5 or 10x. Maybe the other one is a real gem, and I hold that for the long term, right? But as you see, that strategy, I think is a more effective strategy than just blindly holding indefinitely, right? Whatever you buy, whether it does well or not, you want to recoup your initial investment as quickly as possible, and then if you have any good ones, you keep that for the long term, right? So in my case, my Bored Ape, although I didn't mint this, I bought this on OpenSea, and it had a pretty good rarity score, if I can. Okay, that is not it. Okay, I can't pull it up because I'm not logged in. But anyway, I mean, that at a high level is NFTs. I mean, and at an even higher level, that concludes the book and this 4-hour live masterclass on crypto investing guide, how to invest in Bitcoin, DeFi, NFTs, and more. Okay, all right, so I can take a few questions, then we wrap things up because it is getting late here, and I'm on vacation. Okay, let's see here. Anybody with any questions regarding the book? Yeah, and once again, you can buy the book on Amazon by just search for Crypto Investing Guide. And the audiobook is now available, as mentioned, audiobook available on Amazon. You can also get the audiobook on Audible, iTunes as well, Crypto Investing Guide. And we still have the TM Holiday 25% off coupon for any annual plan subscriptions. Just go to tokenmetrics.com, sign up, put in the coupon code TM Holiday. I'm sorry, TM Holidays, one word, all caps, and you should be good to go. All right, so what questions do you have as we wrap things up? Let me check the comments. How to stake in Olympus DAO? There are lots of videos online showing you how to do it. You can also do it directly on their site. There should be instructions showing you how to do it. Thank you, Maida Zavani. I appreciate that. Yemi says, does this current iteration of NFTs not concern you? They're just JPEGs. I feel like there needs to be more evolution of NFTs that bring utility. Yeah, I mean, that takes time, right? Similar with token sales and crypto, utility takes time, right? But that's why 95% of them will go to zero. But in that, there'll be 5% that do very well. I think Bored Apes has shown that it's a breakaway leader. So I think that's the approach I have, right? If you take the approach that everything is going to zero, you'll miss the Bitcoins, the Ethereums, the Solanas of the world, right? So you can't do that as an investor. I believe Ian has a master's degree and went to IBM. Yeah, I mean, I have a master's degree in computer engineering. My focus was telecom networks, and I worked at IBM and Deloitte Consulting. Does Tokenmetrics predict a breakout in DAOs investing in 2022? Yeah, I mean, we covered DAOs. I had a video on TMTV covering this. And I also have an article on DAOs coming out. I think DAOs are definitely a big trend to watch for 2022. Favorite layer ones approaching 2022? Ethereum, Avalanche, Near Protocol. I think those are the main ones. Because Ethereum and Ethereum 2.0 hedges are the ones I would be looking at, right? So anything that's EVM compatible. So Near, with the launch of Aurora, and Solana as well, right? Because they have this new project that's going to be EVM compatible and bring EVM dApps to Solana. That's going to be huge. And we did cover that as part of our code review. Yeah, Phantom is pretty good. Terra Luna, pretty good as well. But I think the space is getting kind of crowded. All right, so that concludes 4 hours, 4-hour live stream. I mean, thank you very much, Crypto family. Happy holidays and Merry Christmas and Happy New Year.
We just landed on the moon in the Lambo.
As we like to say, the moon is not the limit to the moon and beyond. Thank you, Crypto family. We'll see you in 2022. Actually, I think there'll be one last live stream prior to 2022 that I may be on. But if I don't see you, I'll see you in 2022 on the other side. Take this video, share this with a friend, bookmark it. This is for anybody out there who wants to get into crypto and wants a masterclass, because I don't always have time to go through and explain everything from the beginning to where we are now. But this video hopefully covers lots of it. I mean, really, do I do 4-hour live streams since like 2017? So hopefully that was helpful. And thank you and happy holidays.